Okay, so we're going to start off with the key terms to review for chapter 16. On page 320, go to key terms to review 1, letter J. And after that, you're not crossing anything out, just after letter J, you're writing to compare to income producing properties. Because it says analysis of rental income, use roughly in sales comparison approach. I mean, I guess you could just leave it at that too. We don't got to lay down all the details of what's going on. So actually, that's fine. Let me see. Then cost for the okay, and then in key terms 2, letter F. At the end of that, write not exact duplicate. It says cost to rebuild using today's materials and techniques. And then right at the end of that, not an exact duplicate.
I got it.
Back in also next to number 13 in key terms 1, it says income approach. Write, put a slash there, just separating it, and write cap rates right after that, or cap or cap rates.
All right.
All right, we all set? So key terms to review, chapter 16, process of eliminating value, estimating value. Process, probably should put these things on. Huh? Process of estimating value.
An appraisal.
2 is A, correct. A return of the a rate of return demanded by investors in a particular area.
The capitalization rate.
Capitalization or cap rates, correct. The similar nearby property recently sold.
Comparable.
5 is C. Extra that contributes to owner's satisfaction, such as clean air, views, and so on.
An amenity.
1 is D. An independent person trained to provide an unbiased estimate or opinion of value.
Appraiser.
3 is E, correct. Analysis of income, including rental and other factors.
The gross income multiplier.
Correct. Gross income multiplier, 10 is F. Loss of value due to any cause.
Depreciation.
It is depreciation, 7 is G. Loss of value due to factors beyond the property's boundaries.
External obedience.
Obsolescence, external obsolescence. It's obsolete. So external, it's off, meaning it's off the property, and obsolescence, meaning it's outdated or no longer desirable. 8 is H. A loss of value due to worn or outmoded, that's another way of saying outdated features.
Functional obsolescence.
Correct. 9 is I. Analysis of rental income used roughly in the sales comparison approach.
The gross rent multiplier.
Yeah.
Gross
rent multiplier, the GRM. So 11 is J. Earlier you said gross income multiplier. That was the 10 was F. That was taking the GRM into consideration, as well as other factors like sales from concession stands and stuff. That's what the GIM is. We didn't really go over it much other than just saying that. GRM is the one we really need to know, so that's what the one we went over. Okay, so the leave off. Oh, sorry. Okay, appraisal technique that analyzes the cost to build.
Cost approach.
The cost approach, 6 is K. Analysis of value of property using return on investment.
Income approach or cap rates.
Correct. 13 is L. Cap rates was only one of those income approaches. The other one's the GRM. Should be cap rates or GRM. Actually, if you fit that in there after letter 13, cap rates or GRM. All right. Use of land that yields the most money.
The highest and best use.
It is the highest and best use. 12 is M. All right. Key terms 2. What a property actually sells for.
Market price.
In a perfect world, it is. 1 is A. Loss of value due to wear and tear.
Physical deterioration.
3 is B. Location and the buyer's willingness to pay more for certain locations. It means a people's preference of location.
Situs.
Situs, correct. 8 is C. Analysis of values received by different appraisal approaches.
Reconciliation.
Reconciliation. 4 is D. Present worth of future benefits. That could be described as
The value.
3 is E, correct. Cost to rebuild using today's materials and techniques, not an exact duplicate.
A replacement cost.
5 is F, correct. A price that would be paid by an informed buyer.
Market value.
It is market value, and that's what we help people determine when we do a CMA, right? The market value. So 2 is G. Appraisal technique that analyzes the sales price of comparable properties.
The sales comparisons approach.
7 is H, correct. A cost to rebuild exactly using materials like the original.
The reproduction cost.
6 is I. Principle that no one pays more if the same can be had for less.
Substitution.
10 is J. And a parcel of real estate being appraised.
The subject property.
9 is K. See, if you're getting these like that quick, then you're going to do good. Or did you already prepare them and and go through them?
I was studying yesterday a little bit.
Okay, you're doing good. Doing good. Oh, come on. Hold on, my PowerPoint either didn't open or it closed on me. So chapter 17, investment and business brokerage. Slowly opening up. See what I got to contend with? Almost. Okay, I can see it. All right, here we go. So in this chapter 17, investment and business brokerage, we're going to talk about a lot of business lingo, and we're going to talk about the sales of a business. In this chapter, we're going to talk about the advantages and disadvantages of investing in real estate and using real estate as the investment. We're going to describe tax benefits of real estate as an investment, as well as the effects of the New Jersey Uniform Commercial Code, which regulates the sale of businesses and business personal property. So you're going to learn a lot of investment lingo and such in this chapter, and then how that would investment lingo towards real estate as well. But a lot of this is just in general investment lingo, like this. Let's do these highlights here. Learning what leverage is. It's when you use other people's money to invest. That's leverage, basically, in a nutshell. On the next slide, I'll have that for you, but let's just do the highlights right now. And then some of the disadvantages in using real estate. Unlike other investments like stocks or bonds that you could buy stock in the morning and by the afternoon, stocks, you could have a spike and you could struck it rich, or lost it all. So real estate's not like that. Real estate does fluctuate. Real estate market's cyclical. However, it takes time. So you're usually not going to buy real estate and then experience some sort of massive gain very quickly. You'll probably take some kind of a loss if you sell real estate quickly after buying it, unless you force an increase of value by doing improvements to the property or something along those lines. But still, you're not doing that super duper quickly. It's not happening overnight, So unlike stocks and bonds, real estate's not highly liquid over a short period of time. Liquidity, that means the cash is flowing, okay? Anytime you hear liquidity, when talking about investing, they're talking about the money, the flow of money. So you probably take some sort of a loss there. So once again, the advantages of real estate is investing in real estate is to generate some sort of return on your investment. Well, that's like any investment, correct? And then leverage is using borrowed money to do your investment. Using inflation as a hedge, where property values naturally fluctuate. Your property, you own real estate, your property values could go up because the times have changed, the markets have changed, there's more of a demand for it. I mean, you could live in a house and the market values go up and you've done nothing to your house. That's using inflation as a hedge, okay? Now, disadvantages of using real estate as the investment vehicle is it's not highly liquid over the short term, over the short period of time. Requires legal and expert and tax advice, and there may be a high level of risk involved if you don't know what the hell you're doing. So the ways to invest in real estate that can yield a return for you. You can hold on to the property until it appreciates using the market as a hedge, as they put it. And then hope that it increases in value and you show a profit when it's sold at that future date. Let's add that term in there just to how did they word that? Okay. Property held for appreciation. Using inflation as a hedge, as they put it, is generally expected to increase in value and to show profit when sold at some future date. Okay. And income properties held for generating income. As you rent it, you're collecting the rents, right? So you're earning profits while you're owning it. Cash flow is spendable income after expenses. Pyramiding through refinancing is basically as you gain equity in your property, you drain that equity out, use it to buy another property. And then you keep doing this rinse and repeat, rinse and repeat. You could find yourself owning a lot of real estate in a relatively short period of time. However, all of your properties are highly mortgaged because you keep pulling out the equity to reinvest it in something in another real estate, right? So keep refinancing to drain equity to buy another investment property. So all your assets are highly mortgaged. Look, you could use what's it? If you're a veteran, you could get a loan for 0% for 1 to 4 family owner occupied, right? If you're not a veteran, you could get an FHA loan, 3.5% down, buy a 4-family house, your first house there. Then as you build equity, collecting rents and paying down the mortgage and whatnot, and if you do improvements and values go up, and then you drain that equity out, you take a loan against that house, and then you decide that you're going to move to another house. So when you do the cash out refinancing to pull out the equity, you refinance it into a conventional loan. Then you get another FHA loan to buy another primary residence that you plan on living in, because you could only have one outstanding FHA loan at a time. Then you move into that, only 3.5% down. And then you're renting out the other property. So now the other property, the 4 families, completely rented. You keep using all this money to now pay down the mortgages, build equity, and then refinance, take the money out, and use it to buy another house over and over again. That's basically what this is. Now, equity is the difference between the market value and what is owed on the property. Okay, so there's several ways you could build equity: by inflation. You know, the property values just fluctuate naturally on their own. By forcing an increase of value by doing repairs and improvements, or by paying down the debt. You're increasing the equity by changing that difference between what's owed on it. As you pay down the debt, the current market value and what you owe on it, it increases. That's building equity. It's like built-in value, another way to say that. Yeah. So cash flow is spendable income after expenses. Let's highlight that.
Got it.
Okay, some income tax issues for home sellers. Refer queries to your accountants and attorneys. We should not try to act like we know it all, even if we have some knowledge in these things and you gain those knowledge over time. You're not the tax expert. You're not the legal expert. So don't take on that role. Okay, all you'll be taking on is a boatload of liability. So both the federal and state government do have exclusions from capital gains tax on the profits of the sale of the primary residence. This is probably one of the few things we can give advice on to let people know that if you own your property for at least 2 out of 5 years before you sell it, if you are single or you're married and you file separately, you get a state as well as a federal capital gains tax exclusion of up to $250,000 for the sale of your primary residence, meaning you pay $0 in income tax for the profit of the sale of your primary residence, not investment properties, but the house you're living in, your primary residence, if you lived in it for 2 out of the last 5 years. And married couples who file their taxes jointly can get a capital gains tax exclusion of up to $500,000. So if you are young and you don't mind moving a lot, you could buy a house to fix it up, live in it for 2 years, maybe as you're fixing it up, right? And then you sell it. And when you sell it, you pay zero state or federal income tax on the profit of the sale up to these amounts. And then you go reinvest and buy another investment property, rinse and repeat, keep doing this, and you're not paying any income tax and you're making a boatload of money. As long as you live in the house, you could repeat it as often as every 2 years. Just tossing that out there. Now, if the owner lived in the house for less than 2 years, the IRS does allow you to get some sort of a capital gains tax exclusion if you are forced to sell due to a hardship. And what the IRS classifies as a hardship would be a job loss or transfer. That's definitely a hardship. Or health reasons, death, divorce, or multiple births. These are all hardships. So the seller must pay income taxes on the profit of the sale of any investment property, but not for their primary residence. This is only for primary residences. Now we're going to get into, in this chapter, we will get into, though, how we could minimize our tax obligations when selling investment properties. We'll get into that in a moment. But this one, I think we went over in an earlier chapter too, right? This one is on exam, so you will need to know this. So there's that. Now, tax benefits of a 1031 exchange. We're going to learn about this thing called a 1031 exchange on page 327. Let's do these highlights first. Let's do these highlights first, and then we'll go over it. Highlight all these things. Make all these highlights, and then we'll go over that slide explaining the 1031 exchange.
Got it.
Okay. Yeah. Rearrange the order of these slides right quick. And there we go to here. So 1031 exchange, the seller must pay income taxes on the profit from the sale of any investment property, but they could get a capital gain tax exemption from a primary residence. We went over that on just on 2 slides ago, right here, right? Income tax issues for home sellers. Here, let's actually work on that title a little bit. We could what's a more accurate description of that? Let's call it tax breaks, right? Tax breaks for home sellers. That sounds better, right? That's actually more of what's going on anyway.
Yeah.
And then, so for 1031 exchange, this is not for your primary residence. This is for investment properties. You buy a commercial property, or you buy an investment residential rental. That's a house that you're not living in, that you're renting out. It's for rental income. It's for income purposes only. All right. You do have to pay capital gains tax. Capital gains is the profit from that you get from the sale of this property. So sellers must pay income taxes on the profit from the sale of an investment property, but may get a capital gain tax exemption for their primary residence. I don't know why that's in a bullet point. All right. Looks prettier now too. So 1031 exchange allows an investor to defer paying income taxes on the profit of the sale of an investment property if they reinvest it in another similar like-kind investment property. They wouldn't pay income taxes until they eventually reach the realize that gain by cashing it out. And by then, hopefully, they're of retirement age and in a lower tax bracket. Get my drift. That's what's going on right there. So, in order to benefit from the 1031 exchange, strict timelines must be followed to qualify for this tax deferment. You guys did get all these highlights, right?
Yeah, I got it.
And you wrote 1031 exchange above where it just says exchange here. So, right, make sure you got 1031 exchange there.
Yeah, I put it.
1031 is a section of the IRS tax code. So it's not just an exchange, it's section 1031 of the IRS tax code. Allows an investor to defer paying income taxes on the profit of that sale of that investment property. So strict timelines must be followed to qualify for this tax deferment. The strict timelines must be adhered to, otherwise the investor will lose the tax deferment and must pay all the capital gains tax on that sold investment property. So they should get a tax attorney or a CPA involved when doing this. Don't try to do all this stuff on your own. You know, anytime you got to be in contact with the IRS when doing a 1031 exchange. And every time you contact them, it's got to be on a special form, specific form that they want you to use, you know. So make sure you get a tax CPA or tax attorney involved in this transaction. You must notify the IRS that you're going to be doing a 1031 exchange at the time of sale of your current investment property, your current initial investment property. Then the IRS would give that investor 45 days to find a replacement investment property to purchase. And then the IRS gives the investor 180 days, not from that 45-day point, but 180 days in total to close on that purchase. So the IRS gives the investor 45 days to find a replacement property to purchase after selling the first parcel. You know what? I'm going to reword it so it's easier to understand. And a total of 180 days to close on that purchase. It's not 45 days plus 100, but rather 180 days from the sale of the initial investment property. There we go. That clarified it a little bit, right? You don't have to have separate bullet points on that. So somebody could avoid paying the sales income tax on the sale of an investment property as long as they reinvest it and they buy another investment property is basically what they're saying here. Okay. But in order to benefit from this, you have to let the IRS know that that is what you are doing. Otherwise, when you sell that property, you got to pay the income tax on it. Unless you notify them that you're reinvesting that money. And then you have to follow these strict guidelines, these strict timelines. And if you miss out on the date, even by 1 day, you miss out on that tax deferment and you got to pay all the taxes on the sale of that investment property. So make sure you have somebody that's communicating with the IRS, a tax attorney or CPA. So you'll be a team. You're the real estate guy or gal, and you guys are helping person that investors sell their investment property and buy another one. Make sure that they're aware. They'll probably already know this, but they're probably the ones that even suggested it. But make sure that if somebody's going to do a 1031 exchange, selling one investment property and buying another, that they have an attorney involved now, or a tax expert. Now, why would somebody do this? I mean, of course, to avoid paying income tax right now, but why would you do this? Why sell your property at all? Why not just hold on to it? Well, maybe there's a better property that could generate more income for you that you got the opportunity for. So you want to sell your existing investment property and reinvest into another. Or maybe you're moving out of state. And instead of having to try to find somebody, a 1031 isn't exchange, isn't you having to sell your property to somebody and exchange it with somebody else who has an investment property. Good luck trying to find somebody that's going to have that perfect investment property willing to swap with you. This makes it a lot more convenient. It allows you to sell your property, then use those proceeds to purchase another property anywhere, as long as you're reinvesting that money into another similar like kind investment, which would be another real estate asset, right?
Yeah.
And then that avoids it all that payment. It's a basic, easy understanding, right? Everybody got this so far? I mean, this is a fairly easy to understand the concept, right? You got to pay income taxes. The way that you could avoid paying income taxes right now is by reinvesting that money into another investment property. But you got to let the IRS know you're doing that at various stages. And you got to meet those deadlines the IRS gives you. Otherwise, you lose that tax deferment, and you got to pay all of your income taxes. Boom, simple as that. That's what they're explaining in plain English here. Okay, now boot. Boot is if you are selling one investment property and you're purchasing another investment property, and that other investment property is cheaper than the one that you're selling. The difference in value is known as boot. Boot is basically a capital gain too, because boot is loot, and all loot is taxable. It's the capital gain. But boot is specific about 1031 exchange. That's what we call the difference in value. When you're selling one property and buying another, if there's a difference in value, that difference in value is known as boot. And boot is a capital gain, so it's taxable. Boot is loot, and all loot is taxable. That's the way to remember it. Like the pirate's booty, right? It's money. All right, now, capital gains tax is the profit of an investment. Wait, we're missing something here. Slides must have been shuffled around a little bit. Oh, no, we're good. Okay, so capital gain is the taxable profit on an investment. And basis is what is some investor lingo that you'll need to know, that a basis is the investor's initial cost for any investment that they're investing in. Okay. We're so happy to talk about real estate as the investment vehicle here. So real estate is the investment, and the basis is the initial cost to buy that real estate. Okay, we got that? Now, you could buy a property, that cost is called the basis. Now you have to put some money in that property to do some repairs or improvements. Now, all the money you got into the property right now in investment lingo is referred to as the adjusted basis. Oh, look at this. All this investor lingo sounds so simple now. It sounds very complicated, like you need a college degree without it, right? The basis, the adjusted basis. It's like, oh, I don't know. Right? I need a college degree to understand this stuff. No, you don't. You can have a high school diploma, because that's all it's needed to get your real estate license, right? So capital gain is a profit on after expenses. Okay, capital gain is the your profit after expenses that is therefore now taxable. The basis is your initial cost to invest in anything. And if you dump additional money into it, now it's known as the adjusted basis, because that's the basis, your base price, plus money to bling anything out, right? That's the way to think about it. So that's your adjusted basis. Boom. Ain't that difficult to understand this lingo, right? So check this out. I put together this slide. Maybe I should make it more interactive. But boot is when doing a 1031 exchange and the replacement property costs less than the sold investment property. The difference is known as boot, and boot is loot, and all loot is taxable. So you start off with the basis, which is $300,000. That's your initial cost to purchase that investment. And then you dump another 100 grand in it to do some improvements. So you're all in, your adjusted basis is 400,000 now. Now you sell that property for 600,000. And if you just left it there, let's go to the right side of the screen here. If the property, appreciated and you sold it for 600,000, then there's a $200,000 capital gain. You have to pay taxes, income taxes on $200,000 if you stopped it right here. But now if you reinvest all of this, okay, so you have $600,000. If you reinvested that entire $600,000 doing a 1031 exchange, you wouldn't have to pay a penny in income tax. Okay, it's all deferred. But if you're purchasing another investment property that's cheaper than the one that you're selling for $500,000, that difference in value, $100,000 right there, we call that boot. And boot is loot, and all loot is taxable. That's your capital gain. That's the amount that you cashed out now. So you're going to have to pay taxes on $100,000 profit now, not the full $200,000, because you reinvested $100,000 of that. So you're only going to pay partial taxes right now, only on the money that you cash out and put in your pocket today. Okay, that was pretty easy to explain, right?
Yeah.
Fairly easy to understand that. So depreciation. If the property appreciates and sells for 600,000, then there's $200,000 taxable capital gain. Now, I'll add into these slides to make them easier if you see them on your own, that you could get this too. So let's just juice down that text, make it a little smaller. Okay, so property appreciates and sells for $600,000, and there's $200,000 taxable capital gain. If you were to reinvest it all in another income property, you would defer paying any of that tax in a 1031 exchange. There we go. That looks good, right? Now, if you look at this slide, I'm not talking to you, you could still get it. But if you're selling the property and the replacement property costs less, then the difference in price is known as boot, and boot is loot, and all loot is taxable. Boot is loot, and all loot is taxable. Da, 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 da. What did I do? Guess I didn't need to do all that. I'll make it a little smidgen smaller. It'll fit. There we go. Make one little modification to these slideshows and it throws everything out of whack for you. Look at that. Oh, you could always play with it a little bit. Good enough. Good enough. Good enough. All right. All right. Always move the frame. Keep it pretty. Keep it pretty. Beautiful. Mwah. So depreciation is an accounting concept. This is something new, something different. It's an accounting concept to deduct the cost of an investment and any improvements on the investment property for taxation purposes. It's not a reflection of the actual loss of value on the property. So, not a reflection of an actual loss of value on the property. It's used to reduce the taxable income before the taxes are calculated, before the taxes are computed. A property's value cannot be depreciated, deducted all at once. The asset has to be depreciated over a period of years. Its life expectancy as defined by the IRS. Whatever its life expectancy as defined by the IRS is. Okay. Now, the value of the land cannot be deducted. Why is that? Because land does not depreciate. So the value of the land cannot be deducted because land
Does not depreciate.
that's it. Because the general rule that land does not depreciate. Except in extreme circumstances like pollution or oil on the property or something, Now, radiation. So the lifespan as defined by the IRS, is called the economic lifespan of an improvement because it's not the land that you can depreciate, only the improvement. So on residential property, the IRS says that the asset must be depreciated over a period of 27.5 years. So its anticipated lifespan is 27.5 years. And commercial property, it's 39 years. Now, you probably don't need to memorize this, but They'll probably give it to you in an exam question. So what do we call the IRS's, well, the lifespan, the anticipated lifespan of an asset that you have to divide the purchase price of that asset, and you could deduct it from your taxes against your income by reducing your income taxes before you compute the taxes, is called the economic lifespan of an improvement. So, or the economic lifespan. For real estate, it would be the economic lifespan of an improvement because land does not depreciate. So here's an economic lifespan of an improvement question. You guys should just do these, just take care of these highlights right now. So if the property's estimated value is at $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? That's the type of question that they would word. That's the type of way that they would word the question for you. But anyway, let's just highlight this, highlight the first sentence, and put a highlight around the rest of it, and write economic lifespan of an improvement. And then you'll have everything that I was talking about on the previous slide as well.
Got it.
So let's do a math depreciation problem, that same one that was on the previous slide. If the property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? This is not a difficult problem. How would you approach it though? Let's see if you have an idea. Do you have an idea? Look it over for a second. Remember,
I don't have a clue right now.
Okay, well, remember, land does not depreciate. So the first step you got to do is you got to subtract the value of the land from the total value. So you got the property value, and then you got to subtract the value of the land because land cannot be depreciated. And that leaves you an improvement value of $350,000. Now, you just divide that by 27.5 years to find out how much you could deduct on your taxes every year. Because this is an investment, and any investment is tax deductible. The cost for the investment, for the asset, that's going to be generating that income for you. It's like if I buy a computer for my business, if I buy a printer, I could deduct the cost of that. It's a business expense, right? So it could be deducted on your taxes in the year that it's paid. But very expensive and large assets like cars and real estate, these need to be deducted over a period of years. I think cars and trucks and stuff, I think that has to be deducted over a period of 7 years if it's a business expense. Real estate, it's, well, residential, 27.5 years, and commercial, 39 years. So now we just divide this by 27.5 years, and we get $12,727.27 per year. So if we made $100,000 that year, we subtract this amount from $100,000 and what's left over, then you calculate your taxes, your income taxes based on that. That make sense?
Yeah.
Okay. But the question said, well, how much would it depreciate over 3 years? So let's times that by 3 now. And that's how we get the answer. That's not that difficult, was it?
Oh.
Okay. But this is how you solve that problem. Because like you said, you weren't sure how to get started on it. Well, I worked it out, and now it's like, oh, that was simple. Wasn't as complicated as you thought it'd be, right?
No, it wasn't.
Yeah. So the amount that has been depreciated over 3 years, that's 38,000. The per year amount can be used to reduce your taxable income before income taxes are calculated each year for the next 27 and a half years. That's for residential property. It's 39 years for commercial. If you want to snap a picture of how to do this math problem, be my guest. Do so. Click away. Snap, snap.
Yeah, snap the pic.
Yeah, okay. Now, deductions and the federal laws. Well, federal tax law limits the deductibility of losses from rental property. The first $25,000 of loss can be used to offset income from any source. Investors must actively participate in the management and the operation of the property. We call that sweat equity. You cut your own grass, you did your own work and repairs on the property. You did your own property management. That's sweat equity. You do some of your own work instead of just hiring a property manager to take care of everything for you. All right. So it has taxable income, and it has to have taxable income less than $100,000 each year before the deduction is made. Don't worry about it. We're not tax professionals. We don't need to get into the details. Tax laws are always changing too, so don't worry about that. You don't give tax advice like that. You let them talk to their tax attorney. So tax credit is a direct reduction. It's a little bit different than what I just taught you. We just learned about how to reduce your taxable income before the tax is computed. A tax credit, on the other hand, is something entirely different. A tax credit is dollar per dollar matching. It's not reducing your tax dollars by a certain amount and then calculating how much you owe in taxes afterwards. A tax credit will directly reduce how much you owe in taxes. If you have a $10,000 tax credit and you owe $10,000 in taxes, you now owe nothing. Whereas tax deductions, if you have a tax deduction for $10,000, well, you minus $10,000 from your income, and then you calculate the taxes based on your income that's left after that computation. So you could still end up owing money. So tax credits are much more valuable than tax deductions. Okay. So you got this highlighted? Tax credit is a direct reduction in tax due rather than a deduction from income tax before it is computed.
Yeah, I got it. So
it's far greater value. A tax credit is far greater value. And I'm going to show you a math problem. I'll show you how to do this. But let's take a look and see what else they got in here. So tax credits have been provided for taxpayers who renovate historic properties that are designated by the Department of Interior of the federal government, listed in the National Register as historic landmark sites, or property of historic significance located in a state certified historic district. You know how you got historic sections of town? Well,
Yeah.
Before you could do any construction on a house, you got to get permission, not just from the building department, but from the historic society. Well, you're also allowed a taxable credit of 20% of the money spent on any renovations that you do to your house within these districts. So, wow, that could be pretty valuable. It kind of sucks because it's restrictive, because you can't typically change the footprint on the exterior of that building. You got to keep the historic look on the outside. You can't be adding on decks and in-ground pools and putting additions on the house. But any renovations you do inside and outside, you get a tax credit of 20% on that money that you use to renovate that house. That could be valuable. So the work must be accomplished in accordance with the federal historic property guidelines and certified by the Department of the Interior. After renovation, the property must be used as a place of business or rented. It cannot be used as your personal residence of the person taking the tax credit. Okay. So I guess that's for business use to try to keep it historic. So there's a credit of 10% of rehabilitation costs for non-historic buildings placed in service before 1936. Non-historic buildings must be non-residential property. Once again, damn. So the law also provides tax credits ranging from 4% to 9% each year over a 10-year period for expenditures or on new construction or renovation of certain low-income housing as well. So these are the times that you typically get tax credits. But sometimes the government steps in and intervenes in things that they should not, and they offer tax credits as well. Like when the real estate market was crashing. The real estate market was artificially inflated by politicians who were not doing their job of regulating. They were supposed to be regulating banks. I shouldn't say they weren't doing their job. They intentionally told banks to ignore the regulations and give more loans out so that they could target poor people and minorities. Because this was something that, if you remember a politician named Barney Frank, now there's more than one politician involved that could have placed some blame to this. Everybody put a little bit of a contribution to this. I mean, back in the 70s, Jimmy Carter created something called the Community Reinvestment Act. It made housing more widely available and getting the loans for it more affordable, but it also put some rules in place that led to this possibility of this happening. And so real estate values crept up since the 70s quite some bit. You know, my parents bought their house in late 70s, even 1978, 76 or 78, and they bought it for, I think it was $16,000 or $18,000 at like an 18% interest rate. That's what it was back then. Can you imagine? Imagine a house being that cheap. How the hell can you build a house? You can't even build a house that cheap today. Why? Inflation. What has happened? What has our politicians done that everything, the cost of everything has gone up so much? And that's a question I'll leave for you to toss around in your heads. But anyway, right now we are 2023, and now the property values in my neighborhood for that very same house is in the 600,000 range. Could have possibly led to that. Anyway, so property values, they were artificially inflated a bit. Okay, so, but that was mild that the property's values were started going up. And then in President Clinton's term, he expanded on that Community Reinvestment Act a bit. And then you saw property values kind of spike up a little bit. And then they kind of leveled out, but they still kept going up, but not as quite a high spike. And then during that same term of Clinton, you had a politician that was put in charge of, within his cabinet, that was put in charge of heading up the division of managing banking regulations. Okay, that guy was Barney Frank. Barney Frank was supposed to be just making sure that the regulators were doing their job and regulating the banks, that they're following the guidelines and the rules of conventional banking theory, that has sound theory, to make sure that they're not writing a lot of bad loans to people that are going to be that they know are going to default on, pulling people into financial troubles, and then possibly subjecting banks to fines and even loss of their license if they write too many bad loans. Instead, he took it a different way. He pulled the regulators in of the banking industry, those investigators, and he pulled them in, and he had this hearing on Capitol Hill, you know, and of course it was filmed, it was on C-SPAN, and he started yelling and shouting at them about how what do banks do to make sure that more poor people and minorities get housing? And he's like, well, the banks give loans. This is the way they give loans. They give loans based on those who come to them seeking a loan. Okay. It doesn't work the other way around. So the banks come to them seeking a loan so that they could purchase a property. And then they calculate whether they could get that loan based on several factors of risk. You know, their credit score, their debt to how much money do they make, how much expenses they have, and then they make sound conditions of loans of how much they could afford based on their income and their debts, their assets, and risk. And Barney Frank was like, I don't want to hear any of that. That's nonsense. I want to. If these banks don't start giving more loans to poor people and minorities, then we're going to start fining them, and we're going to yank their licenses. And the regulators were like, well, banks don't really look at the color of people's skin when given a loan. It's supposed to be based off of their financial records that they submit. They don't even meet the people. And he's like, I don't want to hear any of that. I don't want to hear any of that. The way the guy talked with this lisp. He's like, if they don't start giving more loans to poor people and minorities, we're going to yank their licenses and start fining them heavily. So banks had their ears on. They were like, all right, we got this. So we'll start targeting poor people, giving them loans that we know that they're going to default on anyway, but we'll just make it a way that we get some money up front to kind of limit our losses on that, and then we'll have it as a write-off. That shouldn't be too much anyway. But then we're going to have to target all these minority groups. So we're going to have to start advertising directly places where they shop, what they look for, and what they look at. We're going to have to start sending mailing groups targeting only minority groups, sending mailings out to them, giving them loan offers and such. But wait, we already offer loans to everybody, and the advertisements are already out there for everybody, and they could come in and get a loan if they wanted to. It's like, so how do we target minorities to get them to come in? Well, what we could start doing is we could start telling them that we're going to offer some new loan programs. We're going to offer them, let's see, you know what? We'll give them a teaser rate on the adjustable rate mortgages so that it'll be fixed for the first couple of years. But for the first year, it'll be the interest rate will be well below whatever you can get in the current market. That ought to get them in. And then it's going to go up the next year, but it'll still be fixed for the next couple of years, 5 or 7 years. That ought to get them in. And we'll also offer some other programs like stated income and stated assets, where they don't need to prove how much money they make, and they don't need to show us their bank statements. They don't need to show us their tax returns. They only have to write them down on an application, how much money they make and what their assets are. And then we'll lend to them based on just what they tell us without even verifying it. Oh, that'll make it a lot easier. So basically, they're lowering the lending standards and removing the whole security part of it by checking and double checking, making sure that those statements are true. And now you have a lot of people that are coming in saying, wow, I could get a house, and all I got to do is tell them I make this much money and I got this much assets, and they'll lend me the money so I can buy a house. Sure. Now, did a lot of fraud go on from the homeowners, from the home buyers aspect, where they lied to the banks about what their income and assets were so that they could get loans? Absolutely.
Yeah.
Absolutely.
Absolutely.
You had bus drivers that were claiming they made 300 grand a year. You know, I mean, come on, it wasn't even realistic. You know, so the real estate, now you had people who previously could not qualify for loans were able to qualify for loans. So what do you think this did to people who already could qualify for those loans? They could qualify for even more money, because you lowered the lending standard so that these people can get those same loans. So people who already could qualify for that much more. Now, if you got a homeowner that's looking to sell their house, what does that mean to them? That means they could get more money for the house because people could afford to borrow more.
if they could borrow more, I want more. So people demanded more money for their homes. So what do you think happened to the real estate prices?
Went up.
They went up at a trajectory, like it went from like this kind of a rise. Hold on, so that I can make sure that you're seeing my screen here. It went from this kind of a rise, for a trajectory for values going up over the years, to this kind of rise. The curve. We studied COVID and the curve, so we all understand how the curve works, right? So
Yeah.
instead of going at a curve like this, at a steady rise, now all of a sudden it was going more like this. We've seen some years where property values, somebody's house value, like a $300,000 house, its value increased 100 grand in 1 year. Tell me that's not a bubble that's bound to burst. There's something wrong there. It was artificially inflated. And that was by the regulators and the government that gave the banks the green light to engage in predatory lending, which later on became a bad thing because they were targeting minorities and poor people and brought them into financial hardships. But you told us to, right? I mean, this is the way politicians are. They talk out both ends of their mouth, like, we want you to give more loans to poor people and minorities. Well, we give loans to people based on what they can afford. I don't care about that. You need to give more loans to poor people and minorities. But the poor people are going to default on those loans if we give them to them. And minorities can come in and get loans right now as long as they qualify for them. So banks started targeting them, created these new loan programs, lowered the lending standards. People could borrow more. People who couldn't borrow can now borrow. People who previously can borrow more. And now property values started shooting up because people started paying more. They started getting in these bidding wars. I could borrow more. It's still going to cost me cheaper to pay the loan. So it was crazy. Eventually, that bubble burst in 2006. And when that bubble burst, politicians said, oh, we got to do something to stop this. The property values are plunging like crazy. Politicians, in all their arrogance, figured that they got the answer to everything. So what did they do? They decided they were going to give a tax credit to property owners for $7,500 if you rush out, or to buyers, if you rush out and you buy a house. I think that started in 2009, mid 2009 to 2010. For 1 year, they offered a $7,500 tax credit to anybody who rushed out and bought a house, hoping that enough people rush out, it'll slow the curve of the downward spiral of property values because nobody was buying anymore as the property values plummeted. And so people did go out and buy houses, but it only mildly slowed the curve and brought it it moved it from it changed it from a downward trajectory like this to only like this. Okay. But it was still, property values were still dropping, but people were banking on that 7,500 being enough we got to be near the bottom now. The property values diving. So that 7,500 may be enough to make it worth it for us to get by that hump, But after that year, that tax credit went away, and property values continued to plummet again. And then people were scared, and then they sold. They got out. You only realize a loss when you sell an asset at a loss. If property values bounced back, you would have lost nothing. So in the fear of this, people dumped the houses. They sold them. And because they sold them for less than what they owed, they were either getting foreclosed on or they were doing short sales. We're negotiating with the bank to accept less than what's owed. But then that forgiven amount is usually taxed. So President Bush, he put out there a thing that the federal government will forgive any tax on those forgiven funds. And then later on, President Obama extended that even further again. And then they offered under Bush, they didn't have those tax credits yet, but people were still doing short sales and getting foreclosed on and doing short sales. But then in 2009, 2010, they started doing the tax credits, which pulled people into housing that previously didn't own a house. So now they pulled people into the financial, the housing market bomb that was going off, that they previously wouldn't have been affected by this. And now to try to slow the curve and flatten the curve, and they did for a little while. All they did is they lengthened out how long the market was going to take to adjust itself, because it was artificially inflated to begin with. So then property values started dropping again, and now those people bought, they bailed out, they lost. And the thing is, there was a catch attached to that money, that $7,500. You had to live in the house for at least 3 years. If you sold it before the 3 years, you had to pay it all back to the IRS, and the IRS would come knocking on your door, so you need to pay it all back right now. Otherwise, you're going to get late fees and penalties and compounding interest on that. So they pulled a lot of people into financial hardship, even those ones that successfully managed to do the short sales. Now the IRS is banging on their door. You owe us $7,500, you know. So politicians actually made the problem worse for many people. And then the politicians, in all their arrogance, said, you know what? That wasn't really a problem. You know what the problem was? We didn't offer people enough money. That's always the solution for politicians, right? Throw more money at the issue. So they decided they were going to do what's that, an $11,000 tax credit, because they didn't throw enough money at the problem. So now when they offered 11,000, people were like, we gotta be near the bottom of the real estate market now. And then you had even more people rush out, and that curve did practically flatten for that year, until the tax credit went away. And then property values plummeted again, continued to correct themselves. And then more people, this time the IRS came knocking after short sales and foreclosures, and they owed even more money, $11,000. And the IRS ain't going away on that. They're like, you need to pay it. We're not giving that up. You need to pay it. You know, if the politicians really cared about anybody, they'd be like, oh, if you got a tax credit, you know, you don't got to pay it back because, you know, unfortunate situations. But they said, nope, you bailed out. And because you bailed out, that did affect the housing market, and that's not what we were trying to do. And so therefore you need to pay the tax credit, the fine, the penalty. You got to pay it back, tax credit. So politicians just pulled more people into financial hardship. That's all that happened. It doesn't matter if they were well-meaning or not. They're arrogant. They think that they have the solution to everything, and they end up screwing things up more than if they never got involved. This is why smaller government and less government intrusion in our personal lives is a better thing, because usually they screw shit up. Right? Pardon my French. All right. So a tax credit is a direct reduction on taxes due, rather than calculating a deduction from income tax income before tax is computed. So tax credits are available to taxpayers who renovate historic properties, non-historic buildings placed in service before 1936, or sometimes government offers a tax credit as a stimulus. That's $7,500, and then the other $11,000 that was offered between 2008 and 2010. So this was offered to anyone who rushed out to buy a home during this period, you know, and then they had to, but they had to pay, 3 years to live in that house. Otherwise, they'd be subject to pay it all back to the IRS. And then they had the short sales and all. Oh, I want to add something to this slide. I'm going to add a little notation down here on this slide here. Let me move this stuff up a little bit, make some additional room. And make this a little bit smaller though. A movie was released which talked about what led to the housing market inflation and crash. Not with specificity as to who was responsible, but in general, talking about the real estate market crash of 2006. They called it the housing bubble, or the the real estate bubble burst. The housing market crashed. Okay, it was actually the mortgage market that crashed when people failed to pay back the loans. Let's say we talked about it led to the housing market inflation and crash, not with specificity as who's responsible, but in general talking about the real estate mortgage and value market crash of 2006. Boom. Because and then that crash was just prolonged for years too, because we also had things like those adjustable rate mortgages. Remember, they were fixed for the first couple of years, and then they would become adjustable. Well, they targeted a lot of poor people and minorities with these, and they said, wow, these are great deals. You know, with the real estate properties going up and up and up and up, I could just buy the house, and then as the values go up, once I reach 20% equity, I could just refinance into a fixed rate loan that's I don't have to worry about. That'll have an affordable payment on there. But the problem is the real estate market crashed. That was gambling, hoping that the values continued to rise. But when they didn't, and they flattened, and then they fell sharply, you're not going to refinance a property. Who's going to give you a loan to pay off your existing loan for a house that's not worth what you owe? Nobody. And so that was the crux of the problem right there. Anyway, so that's the real estate market, the market bubble crash and all that. Oh, I guess it would help if I put in there what that movie was called. A movie called The Big Short was released, okay? Did I tell you guys about this when we were going over the mortgage chapters?
Yeah, you did.
I did? Oh, okay. I thought I
Yeah.
forgot to. Okay, so then sorry for all the big speeches again, but yeah, just telling people and informing them. Listen, you're not going to be able to spot these things happening again in the future if nobody ever told you about them or educated you about them to begin with. You know, there's certain signs and things you could look for, and you could see what direction the real estate market's going to take. And if you could see that something is coming, you could better prepare for it working in the industry. You know, maybe I should start sharpening my short sale skills, and maybe I should start targeting getting listings from people who got loans 3 years ago or 4 years ago, and those maybe that are getting behind in their mortgage payments, because that may be the first signs here. All right, so I'm going to show you now the real value, how much more a tax credit is worth than a tax deduction. Tax credit's a direct reduction in taxes due rather than calculating deduction from income before tax is computed. So we learned that tax credits are way more valuable. Tax credit is way more valuable than a tax deduction. And I'm going to show you that right now we're going to compare a tax deduction of $15,000 versus a tax credit of $15,000. Assuming that somebody has a $100,000 income and they're in a 15% tax bracket, that's how much would they pay in their taxes. So basically, if you have $100,000 income and you get a $15,000 tax credit, you subtract that, tax deduction. You subtract that $15,000 from your income before the taxes are computed. And now you have $85,000 of income. Your taxes, your taxable income has been lowered to $85,000. And now you calculate your taxes. If you're in a 15% tax bracket, times that by 15%, and now you owe $12,750 in income taxes. All right. Now let's give that same tax $15,000 as a tax credit. You owe $100,000 income tax. You're in a 15% tax bracket, so you calculate your taxes now, and you owe $15,000 in income taxes. But then you're given a $15,000 tax credit, so you owe nothing. So which one's more valuable?
Tax credit.
And now I made that visualization very apparent to you, right? I mean,
Yeah, you did.
damn. If I just said these words to you, you're like, tax deduction, tax credit's more valuable, blah, 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 blah. Tax deduction is calculated before you calculate the taxes. Tax credit is calculated after your taxes are calculated, you know, and it's like, all right, and you're confused and you hear a lot of these words and blah, blah, blah. But I just gave you a nice visualization here. So in a tax deduction, you would have still owed $12,750. With that same $15,000 as a tax credit, you owe nothing. It's dollar per dollar credit that you actually get. And look, so a tax credit is way more valuable than a tax deduction, as you can see by the example above. Now, this is not a math problem you're going to get or anything like that. So there's really no need to take a picture of it unless you just want to see for yourself and memorialize, wow, what a contrast difference a tax credit can be versus a tax deduction. All right. So land contracts, we learned about these already in chapter 11. And then again, I think in one of the mortgage chapters, we learned that a land contract is a type of seller financing. Remember that? Recall that? It's a type of seller financing, also known as an installment sales contract, where the buyer does not get the deed right away. They have to they make payments towards the purchase, and it's seller financing, but it's this type of seller financing where the seller does not give the deed and turn over the ownership to the buyer until they paid off the full amount owed or some other amount that they have agreed upon would be sufficient before they turn that over. Right? So that's what a land contract is. Again, real estate investment syndicates. What is a syndicate? Well, it's not a legally formed business entity. We learned about this in chapter 5 or 6. It's just two or more people coming together to carry out a business project. When the project is done, the syndicate's done. You don't have to file any special paperwork or documents and register a syndicate with the state or federal government. It's just two or more people coming together to do a project, a business project. When the project's done, well, the syndicate's done. It's just called a syndicate. And now when you have two or more groups of people that come together to carry out a business project, like two or more business entities or groups, that's called a joint venture. When two or more groups or organizations come together to carry out a business project, that's called a joint venture. Once again, not a legally formed business entity. So real estate investment syndicate or a real estate investment syndicate is a business venture in which a group of people pool their resources to buy and own and or develop a particular piece of property. Okay, that's what a syndicate is. Real estate investment syndicate. It's like a group of little old ladies around the table pooling their funds together to invest in a shopping center and then live off of the rents that they collect, right? Now, a warning, when seeking money from investors to invest in real estate project that you own and offering a percentage of the profit to investors, that's not a syndicate because you own it. This could be a real estate security. So I shouldn't have syndicates listed up there for that, but more along the lines of real estate as a security. So you as a real estate agent are going to be helping a lot of buyers out there and investors, and pretty soon you're going to develop this eagle eye that you could spot a good investment property a mile away, and you could see what could be done to it, and you can make a lot of money with it too. Only if you had the money to buy it and do the investment like all these other people who already have the money do. Damn, wish I had the money. Then a light bulb pops off in your head and you say, wait, I got an idea. How about I advertise to try to get some bunch of investors out there to invest in my project that I will own? Well, what's in it for them? Well, you may offer them a percentage of the profits, but you're going to own the property. Be careful, because this could be classified as a security. And securities, when they're offered to the public, first they need to be registered with the state and federal government. And those who are offering securities have to prepare a prospectus that informs the public before they invest about all the risk involved. And the person who creates these prospectus and that registers them and that can sell securities has to have special licensing to deal in securities. And if that security is also real estate, then they also need to have a real estate license. Or you could have one person with a securities license and another person with a real estate license involved, and then you could do things copacetic and everything will be good. But often that does not happen. And you get the real estate agents that get this idea perhaps, and now they pull people in to invest in the project that they'll own, that not the investors will own, in exchange for all these promises of riches that they could make. But what happens if they lose out? What happens especially if these people are not savvy in investing in real estate and they lose money? They're probably going to come after you and you're going to do some jail time. So this could be classified as a security. And this explains everything that I just spoke about there without me having to read it all. But special licensing is required to deal in securities. And the state of New Jersey also has what we call blue sky laws that regulate the sale of securities and their offerings. So does in the federal government, the FTC and SEC regulate those things as well. All right. So just be warned about that. Now, we learned about partnerships back in chapter 7. We have a general partnership where all the owners of the business take an active role working in the day-to-day business dealings. They could be held liable for any additional debts the business takes on. Limited partnerships has at least one general partner who works in the business, and they can be held liable for any additional debts the business takes on. And all the limited investors, the limited partners, they're limited in their liability to the extent of their initial investment in that business, and that's all that they stand to lose. Now, REITs, a real estate investment trust. REIT investors can take the same tax advantages as mutual fund investors. We went over this previously, I think chapter 7 as well. And we forward, and we probably already have this highlighted on page 331, right?
Yeah.
Okay. So a REIT, in order to be classified as a REIT, a real estate investment trust, who says you need to invest in mutual funds in your retirement plans? Why? And those mutual funds investing in stocks and bonds. Why not be able to invest in real estate as the investment vehicle instead of stock market? Well, you can. It's called a REIT, a real estate investment trust. Now, in order to have a REIT, it has to be classified as a REIT. It must, that investment trust has to have at least 100 investors involved, and about 75% of that, a minimum of 75% of that trust income has to come from real estate as the investment. All right, so who do REIT investors get the same tax advantages as? Mutual fund investors. That'll be on exam. That's an exam question. REIT investors get the same tax benefits as mutual fund investors. Boom. That's all you need to know about this. You probably won't see this on the state exam at all, but school exam, probably.
All right.
Now, you don't need to have a real estate license to sell a business. Do you need to have a real estate license to sell a business?
No.
No, unless real estate's involved. So if you're selling the business and that business owns real estate, then you need to have somebody with a real estate license involved in the sale of that business. Got it?
Got it.
So real estate, if it's included in the sale, you need to have a real estate license. But if there is no real estate included in the sale, then you don't. So a lease or real estate sales contract needs to be transferred, negotiated, and prepared by attorneys. So why do they need us? Well, to market it. But because we sell real estate, we market that real estate, we find the buyers for it. But we don't actually prepare the contracts for commercial properties or industrial properties or any of those commercial businesses. We don't actually prepare the contracts for the sale of them. Maybe we could prepare a non-binding intent to purchase or lease, and then the attorney will then take over and actually write up the contract based on some of those terms. Now, there's a lot involved with the sale of businesses itself, just the business. Forget about the real estate aspect of it, which attorneys will handle anyway. But the real estate aspect, the business aspect of it, how do you sell a business? I mean, there's a lot involved, and you really need an attorney to handle this stuff. Because there's things like the assets of the business, like the trade fixtures, the stock and inventory, maybe the business name itself. Maybe it was registered as a corporation or an LLC. How do you transfer the ownership of that? Customer lists, goodwill, a legal term there, or special rights such as copyrights, patents, franchises, and special licenses. How do those get transferred from business to business? Or a picket lottery machine, how does that get, if that's included, like you're selling a bar that or a convenience store, it has a picket lottery machine. How do you transfer that license, or can you? How do we handle that? So that needs to be addressed, and the attorneys can handle that stuff. So, get an attorney involved is basically what I'm saying. So let's do this highlight here, that a person who sells or negotiates the sale of a business, you don't need to have a real estate license unless
Property is involved, real estate property.
there you go, unless real estate's involved. There you go. Bing, bing, bing. That's it.
Got it.
Now, when purchasing a business requires a substantial down payment for commercial properties. We're looking at usually around 25% or more to put down when buying a commercial property, let alone a business. You're not getting a real estate mortgage loan to buy a business, maybe for the commercial real estate, but substantial down payment and seller providing a purchase money mortgage for the balance of the selling price for that real estate. Financing the purchase of a business itself requires personal loans and anything else here? Yeah. So selling price of the real estate. The business purchase requires cash or personal loans to purchase. Right. Now, New Jersey's adopted the Uniform Commercial Code, the UCC. This is different than the UCC, the Uniform Construction Code, which regulates the construction of and improvements to real estate. This is a UCC, the Uniform Commercial Code, which regulates the sale of businesses. And there's a section of it known as section or Article 6 of the UCC, which is called the Bulk Transfer Act. So the Bulk Transfer Act on page 332, let's highlight this, is designed to protect creditors from the fraud perpetrated by a business owner who sells the business, including any equipment and stock, and then disappears, leaving those creditors unpaid. So basically, you as the real estate agent, if you're selling a business, you need to make a list of all debts to outstand. You need to make sure that the owner makes a list of all outstanding debts to creditors for things that have not been paid in full yet, like the stock or inventory or machinery or anything like that, that when they're selling the business, they may say is included in the business. So if they're buying the business, people are not getting that stuff free and clear and already paid for. They still have not yet been paid in full for yet. So it needs to be made. You need to contact those creditors and let them know that the business is for sale. And then any potential buyer of that business needs to be made aware that these items have not yet been paid for, that there's still outstanding debts to creditors. So the purchaser should require the seller to prepare a list of existing creditors, including their names and business addresses and the amounts owed to each. This list should be signed and affirmed or sworn to by the seller, and it should be made, should include all persons who have possible claims against the business, whether or not the claims are valid. The parties to the transaction, purchaser and seller, should prepare a list of all real and personal property that's included in the sale. And the purchaser should receive the seller's list of creditors for at least 6 months after the date of sale and make a list available for inspection by any of the seller's creditors or recorded in the public record in the county where the property is located so that you can prove that you provided it. So the seller is obligated to provide this list of creditors for completeness and truthfulness. It's against the law to make false statements on such a list when selling a business. So after receiving the list, the purchaser is obligated to notify all listed creditors of the details of this pending sale and how their debts are going to be paid at least 10 days before the sale takes place. And the New Jersey statute of limitations on bulk transfers is 6 months, unless the transfer has been concealed. Creditors have 6 months to file a claim on the title to any personal property. After this notice, the creditors have been sent. If the notice to creditors is not sent and the business is sold without first paying any existing creditors off, the creditor may enforce a lien on the goods and equipment of the business because they still, as if they still belong to the original owner. Highlight, the requirement of the Bulk Transfer Act is designed to protect the interest of the buyer, but as well as the seller's creditors in the sale of a business. If you got a question on exam for this, the Bulk Transfer Act is designed to protect who? The seller's creditors. It also protects the buyers as a side effect. Here. When you get homeowners insurance, who does homeowners insurance protect? It protects the lender. They're the one that requires it. Now, does it protect the home buyer too? Sure, but as a side effect, it's not its main intent, but it does. But its main objective is protecting the creditors of that buyer. But for a business, it protects the seller's creditors because the seller's creditors still have not been paid for the equipment and inventory that they're selling and saying that's included in the business. And if they don't make a list and they just say, hey, everything's included in the sale, and they imply that it's all been paid off, that's a crime. And if you as a real estate agent help them perpetrate that crime in the sale of their business, then you could be found guilty of that crime as well. So the Bulk Transfer Act is designed to protect the seller's creditors in the sale of a business. It also protects the buyer, but as a side effect. Because they are alerted to the fact, because they are informed, or because they should be informed, that all the inventory and machinery or tools of the trade have not yet been paid for in full, and therefore can chase after that seller's personal property or personal assets to get reimbursed. There you go. A little explanation there to help you understand that better there. Okay.
Got it.
Okay, so probably on exam, who does the Bulk Transfer Act protect? The seller's creditors, the business seller's creditors. Throw in there the word chattel. So it's business chattel. What is chattel? Tangible personal property. This is business chattel, right? Tangible personal property has not yet been paid. All right. So the UCC, what you need to know for exams, the Bulk Transfer Act is part of the UCC. The Uniform Commercial Code prevents fraud in the sale of a business chattel. It protects the business seller's creditors from the seller selling the business and its inventory and equipment, saying it is included in the sale, but it has not yet been paid for in full. Then the seller leaves their creditors unpaid. It's fraud. The Bulk Transfer Act, which is Article 6 of the UCC, which is the Uniform Commercial Code, regulates the transfer of chattel when selling a business. It prevents fraud. It requires the business seller to make a list of all outstanding debts to creditors and supply that list to potential buyers, and notify the creditors that the business is for sale. Real estate licensees must ensure these disclosures are made to avoid assisting the seller to commit a crime. To avoid assisting the seller commit a crime. In New Jersey, the Bulk Transfer Act protects the seller's creditors. You notice how I got that in bold, because that's what you need to study. Also protects the buyer and their creditors, but as a side effect. Non-compliance is criminal offense. If the agent helps the seller perpetrate the fraud in the business, well, you help them commit a crime. They can be commit that crime. Real estate brokers may not draw up contracts for commercial property or business transfers. That would be practicing law without a license. Only an attorney can handle these things. There you go. So you may want to snap a picture of this slide, actually. This just gives you pretty in-depth explanation and all that stuff. Similar to what was on a previous slide, but more detail.
Got it.
But all you need to know for exams is, what is the law that deals with business chattel? The Bulk Transfer Acts, correct. What does the Bulk Transfer Act, who does the Bulk Transfer Act protect in the sale of business chattel?
The seller.
The seller's creditors, not the seller, the seller's creditors. The seller of the business is the one that commits the fraud. It protects the seller's creditors who have not been paid yet. It prevents the seller from saying, hey, everything's included in the sale price. And then they leave those creditors unpaid. It's fraud. And that concludes chapter 17. Let's do the key terms to review for chapter 17. And I will update that in the shared Google Drive. Let me see, chapters 16 to 17. Let's make sure those are updated. 16 and 17 in the shared Google Drive. So key terms to review, chapter 17. There are two key terms to review. Next to letter I in key terms 1, just right next to that horrible definition. And I'll tell you, 9 is I. The answer to 9 is I in that first key terms to review. All right. So cost plus improvements minus depreciation.
Adjusted basis.
1 is A. Increase in value.
Appreciation.
2 is B. Initial cost of real estate.
Basis.
3 is C. One thing I'm noticing here, it looks like the book manufacturer for the key terms to review number 1 here, they forgot to mix up the order in which the answers for these key terms are in. I think they're all side by side and they're none of them are mixed up, but I'm going to read them off anyway, and you can still keep doing this so that we know.
Down for real?
Yeah, I think so, for pretty much this whole first key terms to review here. So document, let's see, initial cost for the real estate, you said was the basis. 3 is C. A document transferring ownership of personal property.
The bill of sale.
4 is D. Extra money or property received by one party in an exchange.
Boot.
Yeah, when you're doing a 1031 exchange, that difference in value is known as boot. 5 is E. A law regulating the sale and financing of business, personal property, or chattel.
The Bulk Transfer Act.
6 is F. Taxable profit on the difference between the adjusted basis and the net selling price of an asset.
Capital gain.
It is. 7 is G. Money left from rental income after expenses have been paid.
Cash flow.
Yeah, you want that cash flowing, right? 8 is H, cash flow. And then 9 is I, yearly bookkeeping charge for part of initial cost is depreciation. Yearly bookkeeping charge for part of initial cost. That's horrible. Could have came up with a better definition than that. Tax deferred mutual transfers of income property.
The exchange.
Or more specifically, the one that we learned about, what kind of exchange? Remember the number?
1031.
The 1031 exchange. So 10 is J. Real estate held for rental income.
Income property.
It's income property. 11 is K. All right, key terms 2. This one's not in the same in the order straight up and down. Okay. A law regulating the transfer of business personal property. We know it's the Bulk Transfer Act, but that Bulk Transfer Act is part of this law. The abbreviation is UCC.
The Uniform Commercial Code.
10 is A. Refinancing property to buy more.
Is that permitting?
4 is B, correct. A direct deduction from income taxes due.
Tax credit.
9 is C. A joining together of 2 or more people to carry out a business project.
A real estate investment syndicate.
8 is D. It's just a syndicate.
Just a syndicate.
A group pooling resources to buy real estate.
That one is a real estate investment syndicate.
5 is E, the real estate investment syndicate. The rate at which investors' top dollar is taxed.
Marginal tax rate.
Yeah, 3 is F. A sale in which the seller receives the purchase price over a period of years.
The return.
Like a rent to own. Think of that. They sell the real estate, but they don't get the deed until the full amount is paid, right? So that sale in which the seller receives the purchase price over a period of years, what do we call that process even? That's what the answer is. It's an installment sales.
Okay, yeah.
Installment sale. 1 is G. Extensive use of borrowed money for purchase.
Leverage.
2 is H, leverage. A fund making real estate investments and selling shares.
Real estate investment trust.
That's the REIT. 6 is I. And cash flow plus income tax savings plus appreciation are all examples of
Terms.
a return. Correct. A return on your investment. 7 is J. All right, chapter 18. Subdivision development. Subdivision and development. In this chapter, we're going to talk about the various methods of developing and subdividing land. We're going to learn what a subdivision is. We're going to identify the impacts of environmental regulations and other laws on sales, health, and safety building regulations. So let's start off with some of this terminology that they use here, which you'll never need. Assemblage. What is that? Well, if you got two separate pieces of land and you combine them together, making a larger piece of land, that increase that's called assemblage. You're assembling the land. You're putting them together, right? Assemblage. That increase of value is known as plottage value. You're not going to get either one of these on exam. Subdivider is somebody that buys an undeveloped acreage, and then they lay out that land to be profitably divided up into smaller lots for the sale. They also obtain all the approvals that are needed to do the development and the environmental studies and all that stuff. That's their job. Sometimes a subdivider can also be the developer, but sometimes a subdivider, that's all they do. They buy the land, they prep it for building and sale, for building on, and getting all the permits that are needed for that. And then they sell that at a profit, and they don't get themselves involved in the actual construction, and they sell that to a developer. But sometimes the subdivider could also be a developer. So a developer is someone who builds homes or other buildings on lots and then sells them. Okay. New Jersey, in New Jersey, when a second lot is, should say in New Jersey there, in New Jersey, In New Jersey, when a second lot is sold off a larger parcel, the development is classified as a subdivision. The state of New Jersey allows municipalities to decide what constitutes a major subdivision requiring a public hearing and what constitutes a minor subdivision which does not. A minor subdivision, those are small subdivisions, maybe one or two lots, but it could be more depending on your municipality's rules. Do not require new streets or off-site improvements or public hearings for approvals. A major subdivision does require a public hearing, requires public hearings to get approval. They have a lot more issues to address. And must give the public opportunity to pose questions. Roads, traffic, burden on local school districts, public works services, police, fire, waste removal, water, sewage, drainage, and environmental impact. Are all issues that must be addressed when getting approvals for a major subdivision. Hey, there you go. Land planning precedes the actual subdivision process, which must comply with the municipality's master land plan. Planning boards and the planning commissioners will handle these issues. Dedication, let's highlight that. Dedication You need to know that term. We learned about that first in chapter 5 as well, but that should be on your definition list. Dedication is when you give land to the government for a public use like streets, schools, and parks. You're dedicating that land. You're giving it to the government for use like streets, schools, and parks. So if you're a subdivider, you're doing a subdivision, after you build the streets to get to the houses, you don't need to keep possession and ownership of those and then have to be maintaining them for the rest of your life. That would be ridiculous. You're better off just dedicating that land to the government, to the local town, the local municipality, and let them have to maintain it. Let them have to fix potholes and shovel the snow from it and all that crap, right? So part of the planning is you got to put on those maps, those plat maps of the subdivision, whether you're going to keep those roads private or you're going to dedicate them. Either way, you still get to name them. Assurance by bonding that sewer and street costs are going to be paid. Compliance with local with zoning ordinances governing the use and lot size, fire and safety ordinance, building and construction codes, etc., are all in compliance. A perk test it's known as a perk test for short, but a percolation test or perk test is how let's redo the wording on that. So a percolation test, or for short, perk tests, a perk test is a test of how well soil absorbs liquids for drainage, runoff, septic systems, etc. and its capacities to hold water. All right, so this you'll need to know for exam. A percolation or perk test is a test of how well soil absorbs water. Because if the land on your property has a high clay content and it rains, does that ground absorb water very efficiently?
No.
It usually just sits right on top of it, right? It takes forever. It could be, you could have had a rain last week and you still got a puddle in your backyard, right? It's been 90 degrees ever since and you still got puddles in your backyard. So that is not land that is great to have a septic system in because it doesn't absorb the liquid very well. And you may have to, if you're going to be doing a lot of construction on the land, there's less land to absorb the water. And as it is, the land doesn't absorb it very well to begin with. So how are you going to handle the additional need to handle where that water goes, the drainage of it? These are all things that need to be taken into consideration, and it's all part of the land planning stage. Okay, so that's all part of land planning. Land planning. Okay. So dedication you need to know, and perk test you need to know.
Got it.
So let's highlight dedication of land for streets, schools, and parks. And right next to that, giving land to the government. And next to percolation tests, or let's highlight percolation tests of the soil's absorption and drainage capacities. Got it?
Yeah, I got it.
So here's a little video from this old house that will show you how they actually perform a perk test. If you're interested in that, a lot of times we tell people it's a test of how well soil absorbs liquids, and we leave it at that. Here, let me show you a little video of how they actually do it.
Well, the first thing is to consider when building a house like this.
Oh, let me get myself off screen so it streams better.
Gets out in the country is a septic plan. What to do with the waste and water that needs to leave that building. Now it needs to go into a septic system. There's a couple of key components to a septic system. One is a septic tank. Now this tank will accept waste and water. Now the solids will stay in the tank and be broken down over time by bacteria. But the water that will pass through the tank will now go out through a leach field. Now a leach field is a series of pipes, perforated pipes, that sit below the substrate of the soil. The water will trickle or drip down through the ground. Now, to determine if you can even have a septic system, it starts with a perk test. Brendan Zabricki's with the town of Essex. You've had your share of perk tests, right? I sure have. So what's a perk test? Well, that stands for a percolation test. And it's a field test to simulate how wastewater will travel down through the soil once a septic system is built on top of it. How fast it'll pass through, sort of like water going down through the coffee grounds in a filter. That's a good analogy, yes. Okay. So what have you done to get us to this point? Well, previous to this, we dug several deep holes, about 10 feet down into the ground. Okay. That allowed us to get a look at the various soil layers that you're going to find whenever you dig here in New England. All right, so this is topsoil. What are you seeing? What am I seeing? Well, as you just mentioned, this is your topsoil. Then you go through a layer known as subsoil. You then finally get down to a layer that is really the glacial material. In other words, the glacier brought it in. Yeah. We have determined that this is the most restrictive or most limiting layer in the soil profile. And the septic system code requires that we actually perform the perk test in that most limiting. So you're testing at almost the worst place. The worst place that you're going to have underneath that system. That's correct. So that looks pretty dense right here. So not accept water too well. That's exactly right. So what we did after that is, knowing what we had in the deep holes, we just had the machine dig down a shelf to the top of that most restrictive layer. Right. And we're ready to dig a perk hole that's about 12 inches in diameter and about 18 inches deep. Okay. Then we're going to fill that hole with water and let the hole sit for a little while to make it saturated. That will be a great simulation of how soil will behave when it's wet underneath the leach facility. Then we will use a ruler to watch the rate at which the water drops down through the hole over time. Yeah. And that will give us what's called a perk rate or percolation. So what happens if the rate doesn't drop fast enough? If it doesn't drop fast enough, that would be a limitation to the site that you may not be able to build a septic system in this particular test. Then it is very important. So I'm just going to take this water, pour it into the hole against a board that I've already got set up. What's the board do? What this does is it puts the water into the hole more gently so that we do not stir up the fine material in there. Yeah. And we want to bring this water level up to about 12 inches, and we're going to maintain that level for about 15 minutes, again, to simulate saturated conditions in the soil. Okay. So we'll check that. We're about 9 so far, so we're going to need another bucket of water. All right, Brennan, it has been 15 minutes. We want to see the time it takes to go from 9 inches down to 6 inches. Well, it dropped down to 6 inches in about 27 minutes. So is that good? Yeah, I've seen quicker than that, but it's somewhere right in the middle. But you're telling us that we passed the test, right? Yes, absolutely. Thank you. How wonderful.
Anyway, that's interesting. Seeing how they actually do it. It's kind of seems like a simple test, right? You dig a hole, find the layer of dirt that's the most restrictive for the absorbing of liquid, and then see how long it takes for the ground to absorb it. All right. So part of subdividing is the subdivider seeks out that raw land they could profitably subdivide and determine if its proposed use is consistent with the local zoning and building laws. Then they locate financial backers for their project and initiate their marketing strategies. And this is all done before they ever buy the property. So title to the individual parcels is transferred as lots are sold using a blanket mortgage that has a partial release clause. Remember, a blanket mortgage is a loan used to buy a lot, and then as you sell off smaller lots off the bigger one, that's partial release clause only requires you to pay back part of the loan as you sell off those smaller lots. Impact fees are paid to the municipality by a developer to help the community cope with the added demand and use of its services like the police, fire, school, garbage, public works. And this needs to be negotiated to get approvals for your project. I like to refer to them as the legal bribes that the municipality asks to be paid if you want to get your project approved. So here, I'll add that in there, that's my opinion of that. Okay. Need to be approved for project. Or I can just leave it at that. Legal bribes, municipality asked to be paid. So, I mean, these are expenses, you know, like if you do get a builder that builds several hundred new homes, right? That is going to have a drain on the resources for the water supply demand, for the sewage in those pipes in the local area. It's going to affect the traffic, the school system, right? It is going to have an effect on that municipality. So it is not uncommon to have a municipality ask for impact fees, like asking the builder to donate a fire truck or a couple of police cars, or even build a school, depending on the size of their project that they're building. Sometimes they could just ask for a percentage of the sale from every unit, like 1% of, they want 1% of the sale of every unit that's sold. That would be their impact fee, and then they could decide how they want to spend the money. You know, see, you see why I call them legal bribes?
Yeah.
Yeah. Let me add that in there because I don't think it's even in the book over there. Programs, official sewers. Yeah, they really don't even get into the details of that. So listen, I'll leave the slide here on this slide for you. In the meantime, I'm going to edit the other one while you could do the highlighting over there.
Show me the editing one.
I will.
Okay, okay.
Give me 1 second. I'm almost done with that. There we go. All right, so okay, I finished it up, just polished it up. Let me get to that. I can get that to you in 1 second. All right, so here's the changes I made to that slide. I just wrote in there impact fees paid to the municipality by a developer to help the community cope with the added demand and use of services. That's a pleasant way of basically, i.e. the police, fire department. So, i.e. example, police, fire department, schools, garbage, public works, water and sewage demands. I refer to them as the legal bribes that need to be negotiated to get approvals for the project to be paid to the municipality. As legal bribes that need to be negotiated and paid to the municipality in order to get approvals for the projects. There we go. That wording is better. So there's the final one. Sorry. So I refer to them as the legal bribes that need to be negotiated and paid to the municipality in order to get approvals for the project. The municipality can ask for a fire truck to be donated, or a few police cars, or even a school be built, depending on the size of the project. Sometimes they ask for a percentage of the sale of each unit to be paid to the municipality so they can decide how to use the money themselves. Let me throw that in there, the money themselves. Boom. All right, so that's all part of land planning in the municipality. How do you like my spin on that? You know, they use this very pleasant wording. It helps the community cope with the added demand and use of services. By paying legal bribes. Yeah, you want your project approved? Well, you got to give us 1% of the sale for every house that you sell. Kind of sounds like something the mob would do, right?
Yeah.
But it basically is. I mean, there is some legitimate reasoning behind it, but can this also be abused? Hell yeah. And I don't doubt that it is. Okay, so This is all part of subdividing. And why is subdividing part of a list there? There we go. Okay. Final change to that slide. Sorry. So that's all good now. But yeah, there is some legitimate reasoning behind that, but it could also be abused as well. Okay, so now let's do some highlights on this. We wrote on page 339 here, title to the individual parcels of subdivided land is transferred as the lots are sold. And yeah, using the blanket mortgage with a partial release clause that only requires part of the loan to be paid back as the smaller lots are sold off of the larger one. Then those impact fees paid to the community. Now, most subdivisions, the land is laid out by lot and block. And just like it is throughout your city, the block that you live on is actually numbered. There's a map in tax records that the municipality has maps that show the layout of the land and all the streets and the blocks throughout the municipality. And every block has its own unique individual number. And each property on that block is referred to as a lot. And there's an individual lot number for each block. So you could have block number 316, you have lot number 5. And you could see that even in tax records, lot and block numbers. So once again, that blanket mortgage has that partial release clause that allows selling a smaller lot off of a larger one. And only part of that loan needs to be paid back as those smaller lots are sold off the larger one. All right. And then we have the, so here's that example, so they have one mortgage that for the entire property. And usually when you sell the property, they have that alienation or due on sale clause in the note that says the entire loan needs to be paid back. A blanket mortgage has a modified alienation clause. They call it a partial release clause that allows the smaller lots to be sold off of the larger ones. Let's see. Yeah. Partial release clause allows the seller to sell a small lot, only paying a lot. Modified alienation clause. Okay, I already got that in there. And that's just a picture of it. Now, land planning could also cover how the layout of the streets are going to be. We have here you could see these blocks within the district there or subdivision, and the streets kind of look like these are your traditional rectangular shaped blocks, and then you have each lot. So these blocks would have a number on them, and then each individual lot would be numbered consecutively by number, letter, or both.
Every house has one, right?
Yeah, every property has one. Every property. It's every lot that has one. It's not the house, it's not the structure, it's the lot, the block and lots. Now, like, let me give you an example. Like my brother's he owns a house on a corner lot, and his lot is kind of oversized. And if you actually look at his property in the tax records, there's actually like a little line drawn over here, and there's a lot number for this one and for that one. He actually has 2 lots. His house is on 2 lots, or his property consists of 2 lots. I don't know why they have it like that, but he's got an oversized property with a 2-family house on it, but he's got 2 lots. His side yard is part of his side yard is considered a second lot. It's kind of a narrow piece of property, but it's his lot. If you were just to look and walk around his house, it looks like he's got a big lot, but it's actually consists of 2 lots. And then, so the street pattern here, this is the classic gridiron pattern, and then the more modern curvilinear patterns that you could see like this in a community. So the developer needs to decide, are they going to, what plan are they going to go for the layout of this subdivision? And then we also have the conventional garden estate or the clustered estates. So what is that? That pertains to the layout of the actual lots themselves. Are we going to build and have people have the biggest lot possible that their houses are going to be on? Or are we going to be more environmentally sound and friendly and give people tiny little lots, but we're going to have more park space and open land? Okay, well, depends on what the developer did. See, both of these estates here, the conventional garden estates and the clustered estates, they both have approximately the same housing. The conventional garden has 368 houses, and there's 366 on the clustered estates layout here. There's 1.6 acres of parkland over here, and 23.5 acres of parkland here, which I think is a colossal waste of land. And then we have the linear feet of street and linear feet of street here. Okay, so less roads, I guess, less, only a few less houses, but the houses are much smaller lots. You don't have a big backyard, but you got big open spaces here that are for the community. So here is an example of a small plat map. A plat is a map of a subdivision. And so you see this big square right here, this big square is the property. You see, can you see the outline of this?
Yeah, I see it.
Where the mouse is going? Okay, so this is this is my property as an example. So this is all my property, okay? Now I'm going to decide that I'm going to subdivide my big piece of property that I have here. Here's the main road. The main road is right here. So I'm going to build a road off of the main road onto my property. So this is a private road right now. So I'm going to build a private road onto my property here. I'm going to make my own little cul-de-sac street, which is on my private property. And now I'm going to subdivide the land on around that street. And I'm going to build one. You see how the lots are numbered? 1, 2, 3, 4, 5, 6, 7, 8. You see that? So
yeah.
There are 8. I'm going to subdivide my land, my one big lot, into 8 smaller lots. And then I'm going to put a street there so that then each one can pull into a driveway for each house. Okay. So instead of having one big house on my giant property, I'm going to tear that down. I'm going to build a road here, and I'm going to subdivide it into 8 individual properties. I'm going to build 8 houses here, and this is the layout. And then when I submit these plans to the municipality, I have to state, is this road going to be private, or am I going to dedicate it to the municipality before I submit it for approval? Okay, so this is an example of a small plat map. Now, does this one require a public hearing? Depends on the municipality. What does the municipality consider a minor subdivision that does not require a public hearing and a major subdivision that does? Are 8 houses considered a major subdivision in that town? I don't know. So a plat is what we call the map of the subdivision, indicating the location and boundaries of each individual property. It's also considered a legal description of land. And dedication is giving the land to the government for public use, such as streets, schools, and parks. So this road, am I going to dedicate it? Right? So now we have a better understanding of these terms that we're throwing around here. And you can see these numbers around the property. Well, this first lot here is 50 feet wide by 80 feet deep on one side, 70 feet on another, and 100 feet on this side. So it's not perfectly square here because the road kind of curves. So from this point to here is 80. But this is a perfectly rectangular lot. So it's 70 foot by 100 foot by 70 foot wide by 100 foot deep. Okay. It's the way that you read these maps. All right. Now a plat, there we go. Snap picture of that. Highlight that. A plat is a map of a subdivision indicating the location and boundaries of each individual property. It's also considered a legal description of land. So a plat is a map of a subdivision indicating that location and boundaries of each of the individual properties within that subdivision. So we have this highlighted on page 340, perhaps. If not, do so. A plat is
I got it.
of a subdivision indicating the location and boundaries of the individual properties. And this is a legal description of land that we're going to learn about in chapter 19. You do need to know what a plat map is. So land planning, okay, part of land planning and subdivision plans, we have covenants and restrictions. Covenant is a legal promise, and then restrictions. Restrictions are usually placed in deeds by private parties. Well, not usually, they are placed in deeds by private parties, not by the government. The government has their own powers on how they can restrict how we use our property. We learned about those government powers in an earlier chapter. I think it was chapter 8. So 8 or 9. 9, I think it was actually. So the restrictions are placed in deeds by private parties, not by government. And these restrictions are called restrictive covenants. So what do we call restrictions placed in deeds?
Restrictive covenants.
These are restrictive legal promises. Government does not place them in deeds. We need to have that understanding as well for exams. The government has their own police powers. Oh, it was actually chapter 6 where we, no, chapter 9, there we go, where we learned about all the different powers that the government has, restrictions they could place on our properties through their police powers. Estates and land are based on restrictions that are called fee determinable, defeasible fee, or conditional fee estates, because they're based on a condition. As long as that condition is not violated, or that restriction is not violated, you're the owner forever. However, that ownership is based on restrictions. So restrictions placed in deeds by private parties are called restrictive covenants. And the types of estates and land that are based on a restriction are called fee determinable or defeasible fee estates. Moratorium is a word that means it's a halt. The local government is putting a halt to further development in the area. There's a moratorium. That means they put a stop to it. So a moratorium is a halt to any further development in the area. Now, it's very important for a developer when they get all their approvals and permits for their construction project, when they get them approved, to record them in the public record. Because in the event that a moratorium is called, if they did record their approvals, even after a moratorium is called, they could start and continue through their construction project. But if they did not record those approvals, then they cannot. FHA has minimum standards for new construction, for the materials, and as well as the occupancy of a complex where the majority of the owners need to be owner occupants in order to get an FHA loan and have a complex FHA approved. The builder had to use certain minimums, adhere to certain minimum standards of construction and materials. And then the complex itself has to be majority owner occupied. Now, the development costs are estimated to be 4 to 6 times the cost of buying the raw land itself in order to construct a subdivision or a development. That takes into consideration all the mass earthworks removal and the prepping of the grounds and the engineers and the real estate agents commissions and advertising costs and building of the construction, the actual construction of the buildings, all the permits and fees and legal and all that stuff. It's estimated to be 4 to 6 times the cost of the raw land itself. Density zoning is zoning that restricts the maximum number of homes that can be built per acre. Or another way of saying that is zoning for the most amount of homes that can be built per acre. So remember, these are those 2 links I gave you, how you could check FHA loan limits by county and how to check, see if a condo complex is approved for FHA loans. And if the developer didn't submit for approval, well, a borrower always can, and then try to get the complex approved. All right. Can I change this slide, or are you guys going to snap a picture? Or
I got a picture.
so let's highlight dedicated means turned over to the municipality. This was on page 340. This is on page 341. And moratorium is a halt to further development in the area. And that covenants and restrictions are placed in deeds by private parties called restrictive covenants. All right. I just put a little notation in here. All right. Everybody got the notes?
I got it.
So that development cost, you really don't need to highlight this. You don't need to know this for exams. I just thought it was interesting. And these are the things that it covers. Now, keep in mind, I'm going to tell you something we're going to go over in chapter 21 that we did not obviously get to yet, because this is chapter 18. They're talking here about the costs that are involved in creating a subdivision. And they say it's 4 to 6 times the cost of the raw land itself. And that includes, all the installation of the sewer systems, water mains, everything about the construction project itself. And some legal, the legal cost and other overhead. The financial assistance to school districts and such. Park districts and the like that have to be donated in order to get your plans approved. But it says you should also consider further costs to be incurred. They, of course, would have to be added into the proportionate sales price of each of the building. One thing I want you to take into consideration is I told you guys this before. Anytime you go for like one of these elections and they have those public option questions on the side, if you're not absolutely sure what those questions are about, always vote no.
I work at the polls.
Yeah.
I know, yeah.
Listen, this happened quite a few years back already. Not sure how old you are, but this happened quite a few years back already. That there was a public option question, and it was put in place to allow politicians to create a new tax. And this tax can also be adjusted or raised if necessary and more money was needed without coming back to the public for additional approvals. And they sold it as the name they gave it was the Green Space Expansion Program. Now, I did speak about this in a previous chapter, and it was to create these, the additional taxes to, to fund the stopping of construction or buying property rights or just preserving open space and building parks. Well, there was another question that came about years ago that was even before that. And, in the political climate sphere, where people often like to, people are often pushing their, whatever their agendas are. But in the political climate sphere, they also try to get you to hate a certain group or class of people, because if there's division, then they could better control they could take advantage of the anger of people. This is just a game that politicians play. It's unfortunate because they shouldn't be playing games like that. But that's what we have when we don't have term limits. And they passed a law. They put it on a public option question, and the way that they phrased it was this. They called it the mansion tax. They tried passing a law that says that anytime somebody buys real estate that's over $1 million, that's $1 million or over, that they have to pay a 1% mansion tax. And it'll go to the state for various programs. They didn't really even tell you what it was for or what they're going to do with it. Now, automatically, if I name it the mansion tax, and I say that it's for properties over $1 million, who do you have pictured in your head? What kind of people or class of people do you have pictured in your head?
Wealthy people.
What's that?
Rich people.
Rich people, right? So eat the rich, right? Screw them. Let them pay their fair share. Aren't these the arguments that are always made?
Yeah.
You get that politician from New York, she wears a dress that says eat the rich or kill the rich or tax the rich or whatever the hell it said. It just shows you this is the division that they always push. And it's just so that they could fill their agenda of creating new taxes and laws so they could get more money or they could get more power and control because they built divisiveness. Listen, if you get rich, if you hit the lottery, I'm going to say congratulations, good for you. I'm not going to all of a sudden be a hater against you. Yeah, and that's if you just got it by dumb luck. You know, if you worked hard for what you got and you become very successful, I'm not going to be spiteful towards you. I'm going to be congratulations. I knew that guy or gal, you know. I'm not going to be spiteful against it. Why should you be hateful against somebody because they were successful? I think that's the dumbest thing. You should be happy for people. Hey, congratulations, good for you. Now move on with your life and get over it, you know. So they passed this law called a mansion tax because the way that they dubbed it, and a lot of people automatically have that built into their head. Oh, it's for rich people. Yeah, screw them. Let them pay their fair share. Yeah, let's vote to create another tax where only the rich people who can buy a property $1 million or more will have to pay extra taxes. They have to pay 1% of whatever the purchase price of that property is as a property tax or as a tax. If I were to ask most people to take this class, they'd probably say, yeah, so what's wrong with that? Big deal. Well, right now we're learning about subdivisions and subdivision plans and fees and everything involved. These large subdivisions where you have condo projects and stuff, where, I mean, they could be building homes that are $100,000, $200,000, these condominiums. Are people buying within that price range? Rich people? $100,000, $200,000, $300,000. You got to be rich to buy a house like that? Are you considered rich?
No.
Would you want to pay extra 1% tax just because you're buying a property?
No.
So why would you will that upon rich people too? So they could pay their fair share? Screw them, they got it. Well, these developers that buy this large amounts of land that they're going to build these projects on, you think they may have spent more than $1 million for the land? Just the raw land? They could have.
Yeah.
And probably did. Do you think they're going to eat those costs? Or do you think they're going to build them into the sale of each house and pass that along to the consumer to pay? That's exactly what they do. So all those people that were voting, trying to stick it to the man, trying to stick it to the rich man, you know, because let them pay their fair share. You know, they say karma's a bitch. Well, you just stuck it to yourself. Because if you voted yes for that, you voted for an extra tax that's built into the property that you bought. That's only $200,000 or $300,000 or $150,000. You're paying that extra tax is being passed on to you by the developer. They're not going to eat those losses. You voted to pass them. You voted for them. They have to pay it initially, but they're going to pass it along to you, driving up the cost of the housing even further. So when you try to stick it to the rich guy, who did the people and the public really stick it to? Themselves. You got to think about these. You got to think about these things. That's not on top of your mind, though, when you're at the ballot box and you're like, mansion tax for people who buy properties $1 million or more. Screw them. You know, don't be hateful. When you're hateful, this is what you get. And this is what people voted for in the state of New Jersey. And a lot of them don't even know that those costs were passed on to them. So look at that. They stuck it to themselves, and a lot of them are ignorant to the fact that they did. All right, so density zoning, we already had that on that previous slide. Just have it highlighted here. Everybody got these highlights? Well, actually, you don't need to highlight this, but highlight this.
Got it.
Now, before any construction project takes place, we need to make sure that you're not building on contaminated land. That has happened many, many times in the past. So, who's responsible for the property that they own if it's contaminated? Who's responsible for that contamination? I think it was chapter 8 I showed, or 9, chapter 8 or 9, no, chapter 9, I think it was. I was talking to you about all kinds of environmental issues. I showed you a couple of videos about New Jersey and oil leaking in the ground and contamination, because the politicians that are environmentalists, they passed the laws that protect the environment, that made the homeowner responsible, regardless if you're the one that actually caused the pollution or not on your property. You may be ignorant to the fact. Well, you own the land now, you're responsible for the cleanup. And remember the CERCLA, we were talking about that whole thing. So the current owner of the property is responsible for the cleanup, but they could always try to chase after past owners or those who actually did the contamination, which could have seeped onto your property from a local factory or from an oil tank you had in the ground. Now, environmental impact studies must be done to show that the grounds were tested, make sure they're not contaminated at all and such, and so on and so forth. Especially if it's a federally related project, federally insured, federally funded, what have you. So EIS is what we call those environmental impact studies. These are the reports that test the soil, the environment for contamination, but they also check for how this project will affect the environment. Things like, is there a rare species of animal or what have you, or insect that lives on this property that could be extinct from the globe if you follow through with your project? And if there is, guess what that just did to your project? Ain't nothing happening there. They also check to see, look, during this, if they find during a construction project, if they find that there's that the site may have something of historical significance there, then it may not be able to get built on because it could be designated as a historic landmark or added to a historic registry of some sort. You know, if they find a human remains on a property, first thing you got to do, call the cops. Cops call a coroner. They examine the body to see how old it is. Do we have a crime scene, or did this just become a historic site? Could that put a pause on your construction project or stop it entirely? Yes, it can. Costs you a lot of money, a lot of time. You may not even be able to build, depending on the situation. It even happened to the World Trade Center. You guys remember when the World Trade Centers were knocked down by terrorists, and then they were cleaning it up and doing body recoveries and cleaning up all the debris, and then they were going to build the Freedom Towers in its place. So they had to dig a foundation even deeper for that taller, bigger Freedom Tower. Did you guys know that during that project, they actually found something of historical significance buried underneath the World Trade Center?
I didn't know that. What did they find?
They found a ship, you know, like a pirate ship, like a ship buried underneath. They had to dig deeper. So you had the World Trade Center, so they had a deep foundation. Then they had parking decks and garages underground. But even under that, they found a ship compacted there. Here's a little video I'll show you, just showing you from a news clip. You can do a little more research and find some more in-depth information about this story on YouTube or the History Channel or the Discovery Channel even. They created a whole show about it. Interesting little news article here. Hold on one second as it loads. Can you guys see the YouTube page here?
Yeah, I see it.
Even though it's loading still, you know, right now you don't see anything on the screen, but let's check this out. I want it to be full screen so you guys could see it.
Yeah, well, it's it.
All right, let's go full screen with that. I don't know why YouTube does this. Maybe it's when I'm connected to the Zoom. Okay, there we go. So check this out.
Deposits. It's a ship that was probably put here around this area. This whole block was filled in between about 1790s and 1830s. So we figure the ship probably predates that and was used as part of the land filling process. So they built the ship across the blocks and structures, timber structures for structures on either side. Sunk them to the bottom of the river and used it to create new land along the waterfront. At this point, we really don't know much. So we kind of have to continue our analysis, see what we're, what's under the boat, what's in the dirt, or something that was going to balance everything. I was placed in the early 1800s based on historic maps and trying to show us how the shoreline progressed. Basically, they just sink it little by little, and gradually extend the shoreline. Usually,
So they'd sink it little by little and gradually expand the shoreline. What they're telling you is that where the World Trade Centers are, anybody ever at the World Trade Center here when they were still standing? Did anybody actually ever go there? You see how deep?
Nah, I was too young.
That was actually very deep into Manhattan. Well, where the Freedom Tower is now.
Yeah, I know.
Okay.
I walked around it.
That's pretty far from the shoreline, isn't it?
Yeah.
Just goes to show you how New York City, how Manhattan, how New York City grew. You know that most of it is man-made. It was a little peninsula surrounded by water on three sides, and how they built it by adding backfill and soil and sinking old ships and filling them up with dirt and rocks and stuff to try to build up the land to have buildings on them now, and streets and roads and such. So that all used to be underwater. This was a lot of Manhattan is a lot of New York City there is man-made. Interesting factoid. That's what she's saying. Now, later on, they did test the wood, and they found out that this wood came from the United States from this ship. And this ship was basically made from timbers that were also made to build, for the same wood that held the Liberty Bell in Philadelphia.
Extending the shoreline down. This, tied into commerce and trade of the early 19th century.
Imagine that, building up the shoreline without having all that big, heavy machinery to do so. Back in the 17 or 1800s, they didn't have this big heavy-duty machinery to do all that backfill. A lot of this was labor.
Or, the famous one on Water Street down in the early 1980s. It's the kind of thing that people always think that, it's an exciting find. It's a big find. It's something that's interesting. We get a lot of information about it. It's a very unique part of history that, we wouldn't have access to otherwise.
Interesting thing, they also found, they found some jewelry like around it. So they basically had to stop construction for a while they were, you had the historians that came in, they took wood samples, they picked up the wood, they shipped that wood out to their laboratories, then later to museums. They had to, they found actually gold and silver and cups and jewelry and all kinds of artifacts and stuff like that from the ship itself that they ended up recovering. And you could see that if you look up some additional videos on the on this. There was actually a documentary on it on it was either the History Channel or Discovery Channel or one of those. I think it may have been the History Channel. But interesting factoids there, huh? I mean, who would have known otherwise, right?
That's crazy.
So that's an interesting little factoid there for you. That they actually found a ship. It actually was like a trawler ship for commerce, but the wood of it was found from the northern region of the United States, and it was the same wood from the same area that ended up building that the thing that holds the Liberty Bell there in Philadelphia. All right, so environmental impact studies. This is what we'll highlight on that on page 342. Right, you guys got that?
Yeah, I got it.
Okay, so before any construction can take place in environmentally sensitive areas throughout the state, you got to first get permission from the New Jersey Department of Environmental Protection, not the EPA, but the DEP, because they were granted the authority to regulate the environment in these areas. A lot of times, the government, the federal government, the EPA, they pass along environmental enforcement to state environmental agencies when they have them, and New Jersey does. We have our NJDEP. So the DEP is the New Jersey Environmental Agency, and the EPA is the federal one. And so the DEP regulates certain areas in the state. And what grants them the authority to regulate these areas? Well, the laws that are named after those very areas that they are to regulate. Like any wetlands in New Jersey are covered under the Wetlands Protection Act of 1970. The highlands are protected by the Highlands Water Protection Act. The Pinelands, the Pinelands Protection Act. CAFRA for the coastal areas, and then waterfront under the Waterfront Development Act. So any builder, before they start doing any construction of projects in these environmentally sensitive areas, should always consult the DEP's guide for land use to see who you need to get permission from. And there's a guide here called By Bob. You know what? I never actually clicked on this or looked at this. So this is at the DEP's website. There's a guide there. By Bob. It stands for Before You Buy, Before You Build. And let's see. So let's see. Permit applicability. It now transfers you to a different link here automatically. Permit applicability. Determining if your property is regulated by the Division of Land Resources Protection. So it's a whole guide that you have to go over. Freshwater wetlands, riparian and flood zones, coastal areas, tidelands. Because they got to go by the state regulations as well as federal regulations. And during the Obama administration, he gave additional sweeping authorities to the EPA. A lot of people were saying this is unconstitutional, and unfortunately, a lot of it was, and they ended up getting some of that retracted or curbed. But still, the EPA regulates a lot more area than they normally had the authority to, even today still. You know, even if you own land that has a large puddle on it, it can be regulated as a waterway. It's kind of ridiculous, but people are finding themselves having to fight and spend tens of thousands of dollars in court to try to fight the federal government for what they could do on their own land, where it's unjustly being regulated. So Highlands Water Protection and Planning Act, you know, that protects the New Jersey drinking water in those areas. Okay, so let's see. Then you got the Pinelands Act, the Wetlands Act, Coastal Facilities Act, the Waterfront Development Act. And then we have the Interstate Land Sales Full Disclosure Act, which we visited at the end of chapter 1 when we did chapter 1 in this book. These rules were intended to protect the public from unscrupulous developers and marketers from undue sales pressure, as with timeshare sales. It says that buyers have 7 calendar days to cancel contracts for the purchase or lease of such lands. That's the right of rescission for that new construction. For out-of-state properties marketed to New Jersey residents, or for large in-state subdivisions with 100 lots or more, or those with common area elements with at least 10 units. Stipulate that all contracts and disclosures must be available in the same language the property was advertised in. The contract and disclosures must be professionally translated by multilingual legal experts not just by people who could speak multiple languages, because they got to make sure that some words in language have separate legalese meanings to them. So it's a little more involved than just doing a simple translation of words. So this language requirement applies to all properties advertised in New Jersey, not just new ones, from both in and out of state. And that's pertaining to the anytime you advertise a property in a language, all the contracts and disclosures must be available in the language that it was advertised in. If you advertised it in Spanish, all the contracts and disclosures have to be available in Spanish, but we already have them. But if it was some other language that we don't have readily all the contracts and disclosures available in, well, don't do those advertisements until you get those contracts legally transcribed and then approved by the real estate commission to be used. But that's only if you advertise properties. If you advertise your services in different languages, well, that's a little bit different. So let's do these highlights if you did not already have them. And let me know when you got them.
I already got this.
Okay, got it? All right, everybody got it? Okay, I'll take the silence as a yes, affirmative. So the Interstate Land Sales Full Disclosure Act.
Yes, you have it.
Oh, you did have it, or you still need to?
No, I have it.
So the Interstate Land Sales Full Disclosure Act, the rules are intended to protect the public from those unscrupulous developers. Once again, it gives them that 7-day right of rescission to back out of the contract. And it applies to out-of-state properties marketed to New Jersey residents or for large in-state subdivisions with at least 100 lots, or common area elements are involved with at least 10 lots. All right, so you highlighted this, right? Was that on the previous page? 344. 344. No, it was not. Okay, so for certain New Jersey land sales. Yeah. You guys want to grab this highlight here?
This is new construction.
Yeah, this is dealing with new construction. Like I was saying, it was for out-of-state properties, new construction. Yes, this says new construction down here. I'm sorry. New construction for out-of-state properties or for those large in-state subdivisions. It only deals with new construction. For new construction of out-of-state properties or the large in-state subdivisions, it only deals with new construction.
I got it.
Then we have the UCC. This is a different one from the last chapter, which talked about the UCC from the sale of a business. This is the UCC, the Uniform Construction Code, which regulates which is the state's minimum standard for construction throughout the state. That all construction has to meet the state's minimum standards for building. Like if you're ever doing construction on your property, or you get something inspected, some work done, and the inspector says, well, this is not up to code. What code are they talking about? They're talking about the UCC. Yep, the Uniform Construction Code. The Uniform Construction Code. So we highlight this, the state's minimum standard for construction and building, UCC, Uniform Construction Code. And then write good to know down here. You don't need to know this for exam, but this is good to know that it could be useful to you in just your real estate business. I gave this advice to people who thought that they can't do repairs in their building because then it would require them to bring their entire building up to code, and they can't afford to do that. So they were holding off on doing some repairs to their property. Like, there was a bar that you walk into it, it smells like a urinal. And it's like, oh my God, it stinks in here sometimes. And they're like, yeah, that's the sewer pipes need to be redone in the building. But the owner, she was like, I can't afford to do it. She's like, because then I'd have to gut out the bathrooms and redo the bathrooms then to get to those pipes. And if I did that, I'd have to bring the whole building up to code, and I can't afford that. And I was like, no, you don't, because that's on the outside there. That's not going to equal 50% of the construction value or the building value. So only the new construction and work that you need needs to be brought up to code. You don't need to bring the whole entire building up to code on that. And then she ended up getting the work done. So it could be useful in helping people out. And remember, the DCA, the Department of Community Affairs, inspects buildings and schools, commercial properties, and large shopping centers and other buildings with 3 or more units, like residential properties with 3 or more units, not counting the unit the owner lives in. Everything else can be inspected by the local inspectors. The new Warranty and Builders Registration Act requires that all builders of new homes, new Warranty Builders Registration Act. And let's reword this a little bit. Just a little bit. So this requires that all builders of new homes must register a warranty against new home defects for up to 10 years. This 10-year new home warranty has to be purchased and registered with the DCA, the Department of Community Affairs there in Trenton. And it is transferable from one owner to the next. The warranty is good for 10 years. And so any purchaser of this building has to get a 10-year warranty for all new construction in New Jersey. Now, I know it says for varying periods up to 10 years. It is a 10-year warranty. It's just that different things have different amounts of coverage. Like the structural integrity of the building is going to be good for 10 years. But the major appliances like the HVAC system and such, that'll be good for like the first 3 years. So different things have different warranties on them. But it is a 10-year builder's warranty for all new construction that must be purchased by the builder. And then they basically purchase that warranty from through the DCA in Trenton, and they keep it on file there. So enforcement, if there's no local building enforcement inspectors, the state will conduct inspections and do all that code enforcement. the inspections for the construction, as well as the building code enforcement activities. So a lot of municipalities will have their own code enforcement inspector, or they'll share services with the local town. But if they don't, well, then a state inspector comes out to do it. So the state will conduct the inspections and code enforcement activities. And those inspectors would be from the DCA, the Department of Community Affairs there in Trenton. Now, construction permits must be issued before any construction, alteration, demolition, or change of use of a building can be undertaken. Change of use. Change of use. Of a building can be undertaken. Okay. Use or occupancy. Use or occupancy of a building can be undertaken. Okay. Now, it mainly deals with construction, but usually every time you change ownership, the building needs to get inspected. Different towns give it different names. So, how do construction permits work? Well, this is the steps. The UCC, Uniform Construction Code, requires a construction permit be issued before any construction, alteration, demolition, or change of use of a building can be undertaken. Applicants must provide information like the location of the property, construction plans, estimated cost of the work, and the names and addresses of the owners and the designated contractors. The local construction official then must inspect the application and the property to determine whether it conforms with the requirements of the code. Within 20 days, they must either approve the plans or and issue that permit, or reject it in writing, along with providing a cause for that rejection. So reject it in writing, approve the permit, or reject it in writing with the cause of rejection, so that the property owner knows what to do to get it up to code. So if rejected, the applicant may revise the plans to meet the requirements or appeal their rejection to the Construction Board of Appeals. Now, once issued, the construction permit may be revoked if it contains any false or misleading information or omissions, or if construction is not started within 12 months of the permit issue date, or if the work is suspended for 3 months or longer after the work has begun. This is important to know and understand. Sometimes people feel like their town is jerking them around when it comes time to getting permits and do work on their property. Well, this is the process of what they got to give it to you within 20 days or provide a rejection. So, write building codes, because that's a task of enforcing the code. They're talking about building codes. And then highlight the first sentence here. The UCC requires a construction permit. And this is all about what we just read on the other slide. I put together a story about this. Okay. And then after the work is done, you have to get it inspected by the inspector, the other state inspector or the city inspector. And then a certificate of occupancy will be issued that says that the building is safe for human occupation. There is no condition that causes a threat to the health or safety of others. Some municipalities will, they'll call it a CO for new construction. If you're doing work on an existing property, that inspection may be called a COC, Certificate of Compliance. And if you're simply didn't do any construction, you're just changing the use of the building, sometimes they call that a CCO, a continued certificate of occupancy. So only for a change of use inspections to ensure no work has been done without the permits and that the building is up to code when the ownership is transferred. This is something you got to get yourselves used to, guys. Every time, for every house you sell, every building you sell, you got to get a CO. Now, like I said, some towns call that inspection when you're just transferring ownership, even if there was no work done to the house, a CO. Some will call it a CCO, you know, but some towns have these different names for the permits. This is a CO is only for new construction. A COC is for existing buildings that have work done on them. And a CCO is for just transferring the ownership when no work has been done. But some towns, they don't have these different ones. They just give it one name. It's always a CO, you know, so it depends on the town. So that's the deal with that. So, or occupied. The inspection would be required for new construction or for existing when additional work is performed, or for simple transfers of ownership without any construction being done. Some municipalities have different names for these inspections. Some just call them all a CO inspection or a CO certificate. It depends on the municipality. So certificate of continuing occupancy, COC. I'll just say that that's for work done on existing structures, not new construction. CCO CCO's continued certificate of occupancy. Only for change of use or ownership. To ensure no work has been done without permits and the building is up to code when ownership is transferred. Okay, so that's the gist of that. And I hope you guys could read that and it didn't shrink down so damn small that you can't.
I can read it.
Can? Okay. You can still see these highlights?
Yeah.
Oops. This is the COC, Certificate of Compliance. And this is the CCO. Continued certificate of occupancy. There we go. All right, now, the state has certain building safety requirements for buildings have to have smoke detectors, fire detectors, smoke detectors within 10 feet of any sleeping quarters, and carbon monoxide detectors with 10-year sealed non-replaceable batteries must be installed as of 2019. That's a new law that they have to be non-replaceable batteries. Homes built after 1978 required hardwired detectors. Some municipalities require one on each level, as well as hardwired with battery backups. Now, fire extinguishers must be mounted in the kitchen along with the hardware that came with it. These fire extinguishers must be rated to put out ABC type fires and must be under 10 pounds so that they're easy to grab and extinguish fires really quickly. And ABC type fires, these are different types of ratings. So these are the highlights you guys should have here. Did you got these highlights and notes?
Got it.
Yeah.
Okay. So basically, this is what A, B, and C means. A is trash, wood, paper, fires. B is liquid gases and solvents, and C is electrical equipment. And the reason why this law went into effect that requires this is a state law that was signed by acting governor at the time, Richard Cody, in 2005. After there was a rash of these instances that we were seeing on the news where you had the parents that were cooking in the kitchen, the child reached up and grabbed the handles. You know, this is why they now tell you to put the handles facing in the stove. Don't ever leave them hanging out when cooking, because children reach up and they grab, and then the pans were falling on the child, covering them in grease, and they caught fire. And the parents' immediate reaction to put out a fire is you throw water on a fire. But that's the worst thing you could do for a grease fire. It actually gets worse and you spread it. And so there was some horrible instances of this happening, and there were quite a few of them within a relatively short period of time. And the governor was talking to, visiting a school and talking to fifth graders. And a fifth grader suggested to him that, why don't you just make it a law that requires fire extinguishers be in the kitchen? And he said, good idea. So on the suggestion of a fifth grader, the governor passed a law. So now this is the law. It must be mounted in the kitchen or within 10 feet of the kitchen and rated to put out ABC type fires, and it must be under 10 pounds so that it's easily accessible. So this enacted to ensure residents of New Jersey. Okay, now the next thing, the Hotel, Motel, Multiple Dwelling Health and Safety Law was enacted to ensure that residents of New Jersey have a decent standard and safe units of dwelling space. It's the state inspection. We often refer to it as the green card inspection. This must be performed at least once every 5 years. So anytime we're selling a 3-family house, we as real estate agents should instinctively be like, are you up to code Are you up to date on your green card inspection? We should ask the owners this. They'll know what we're talking about. You as a real estate agent must know this because we don't usually refer to it as the state inspection. We just usually call it the green card inspection. On your exams, they'll refer to it as the state inspection. In real life, we just refer to it as the green card inspection. It has nothing to do with immigration green card. This has to deal, this is just what we call the state inspection, because when the building passes the inspection, they always gave a pass inspection certificate that needed to be posted in the hallways, and the color of that card is green. I'm sure these days they just send it by email and they just print it out on their own, so it's not necessarily green, but that's where it got the term from. Now, motels and hotels, also multiple dwellings, hotels and motels, with 10 units of dwelling space or sleeping facilities for at least 25 persons have to be inspected at least once every 3 years. And these buildings only require, do not require inspection, do not require appointments before the inspections. They can be spot inspections. So let's highlight that on page 346. Right here, state green card inspection, and highlight multiple dwellings are inspected at least once every 5 years and hotels at least once every 3. And I believe that would be it for this chapter. Everybody get that?
Got it.
Yeah.
And that is it for this chapter. So let me save the changes. Update chapter 18 in the shared Google Drive right quick, and we do the key terms to review for chapter 18. I'll update 17 and 18 in the shared drive. Oh, I already did 17 before. Okay, that's all right. So now let me close this out, and I will open chapter 19. And we'll do the key terms to review right now. There's only one of them for chapter 18. Charges to developers for extra roads, schools, and so forth.
Impact fees.
7 is A. Those are the impact fees that they pass along. Test of the soil's absorption and drainage capacities.
Percolation test.
That's a perk test. 10 is B. Division of property into more than one building lot is referred to as
A subdivision.
16 is C. Community with dense zoning and developers plan for the entire land use. This is called a planned unit development or a PUD. 12 is D. Group setting standards for local subdivisions.
Planning board.
That would be the planning board. 13 is E. A halt to development in the area.
Moratorium, right?
9 is F. It's a moratorium. New Jersey standard for building.
UCC.
The Uniform Construction Code, the UCC. 17 is G. U.S. requirement that some developments be registered with the Consumer Financial Protection Bureau, the CFPB.
The Interstate Land Sales Full Disclosure Act.
Correct. 8, what was that? Yeah, 8 is H. State regulations for builders of new homes.
The Warranty and Builders Registration Act.
Yes, 18 is I. Permits the buyer up to 7 calendar days to cancel the contract for the lease or purchase of such lands. What permits them that?
The Real Estate Sales Full Disclosure Act.
15 is J, correct. A law regulating, a law requiring registration of certain developments within New Jersey.
That would be the Planned Real Estate Development Act.
11 is K, the Planned Real Estate Development Act. Zoning that allows more living units per acre than usual.
Density zoning.
Density zoning allows you to pack it in to be more dense. 5 is L. A map of a town, section, or subdivision. Also a legal description of land. Yes, a plat map. A plat. 14 is M. New Jersey state agency that approves and registers some out-of-state properties.
Construction permit.
No, what do we call the state agency? Those before those new construction from out-of-state properties can be marketed to New Jersey residents. So maybe there's a timeshare development or construction project in another state that they're advertising in New Jersey. Before they could advertise that new construction in New Jersey, this agency needs to make sure that they got all their ducks in a row and the property actually exists. It's actually an agency that operates within the Real Estate Commission. It's actually a position within the Real Estate Commission. It's called the Bureau of Subdivided Land Sales Control. 1 is N. That's the Bureau. The Bureau is a department. Like the FBI, Federal Bureau of Investigations, right? It's a Bureau of Subdivided Land Sales Control. So 1 is N. And local municipalities authorization for building plans.
That was construction permit.
That's the construction permit. 3 is O. Engineering reports often required before building permits can be issued.
EIS.
The environmental impact studies, the EIS, correct. 6 is P. Turning over of private property, like a subdivision, streets, to a municipality.
Dedication.
Dedication, you're dedicating that land. 4 is Q. And putting living units closer together to leave more open space.
Clustering.
Clustering. 2 is R. And that concludes chapter 18. So let me open up that chapter 19. Oh, do I got it open already? Yeah, look at that. I'm ahead of the game. Boom, 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 boom. Important chapter. There's another important chapter with a lot of questions on exam from this. In this chapter, we're going to talk about legal descriptions and deeds. Chapter 19, legal descriptions and deeds. In this chapter, we're going to discuss the 3 methods of describing real property, the legal descriptions, the 3 legal descriptions of land. We're going to identify 4 types of deeds that are usually used in New Jersey, and we actually went over this in earlier chapters, but we're gonna hit it now again and what they are. Actually, we didn't go over the 4 types of deeds, actually. I think I may have briefly mentioned it, but yeah, we're going to go over the 4 types of deeds. And then we're actually going to we're going to talk about the effects of various different deeds and what they do. And we're going to talk about the anatomy of a deed in general, the parts of a deed. So what is a legal description? Let's just start out there. A legal description, and you guys can do this highlight on the first page of the chapter, 351. Put that page number down there. So a legal description is an exact way of describing real property in a contract, deed, mortgage, or other document that's acceptable in a court of law. And a legal description can be combined or altered only by a competent authority, such as a surveyor or title attorney. The deed is a document that conveys one's right, title, or interest in real property. It doesn't just convey that title, their ownership. And it must include an adequate description of the land that's being conveyed. There are 3 legal descriptions of land: meets and bounds, government survey, also known as a rectangular or government survey, or PLSS, the Public Land Survey System. But you're not going to get that on exam. They're going to use one of these terms, rectangular or government survey. Or a plat map, which is a map of a subdivision located in the, recorded in the county where the land is located. That would be a plat map. Okay. You guys got that highlighted there? The 3 legal descriptions of land: meets and
Yeah,
bounds,
I got it.
rectangular or government survey, and a plat map. You need to know that for exam. They'll just give you a question straight out that you need to know what are the 3 legal descriptions of land, let alone knowing what they are. But we're going to get into all them juicy details right now. So I put together this nice slide for you that says, it puts together a lot of the information, maybe a little bit spread out in the book. So this is pretty much good for all the information pertaining to legal descriptions that you need to study, all on one slide. So that's half of this chapter, all on one slide. Hint, hint, hint. So legal descriptions should always include the name of the county and the state where the land is located. Now, these are some terms that are a little bit towards the end of this first half of the chapter that talks about legal descriptions. But I think they should be discussed first so that we understand the legal descriptions better. A benchmark. Okay, these are things to know. What is a benchmark? It's a local permanent marker that aids surveyors in their measurements, which may be based on them rather than the actual benchmark, which may be miles away. I'll show you pictures of a benchmark so you know what it is too. A datum is a measurement of elevation, the point, line, or surface from which elevation is measured according to the USGS. That's the United States Geological Survey. That's a department. That's a department within the government, the federal government, that they monitor the planet. And it defines zero elevation as the mean sea level at New York Harbor. Not that it's angry, but the mean is the average. Not counting storm systems where we may have higher sea levels than normal. And monuments are those markers that are placed along the boundaries, the corners of the property, so that you can then visualize the boundaries of the property by drawing, by tying a string around one marker to the next. You can actually visually see now where your property line is. These can sometimes be metal stakes in the ground. They could be wood or a ribbon pinned to a tree even. All right, then we got the 3 legal descriptions of land. Let me see really quick here. Let's first go, before we get into those any further, you're going to see this slide a couple times in this chapter. So let me first talk about what a benchmark is. This is a benchmark. These are surveyor benchmarks. Okay, often they could be glued into or put in with mastic into stones and rocks, bricks, posted into the ground, like this post right here, this post right here. On them, they'll usually say who placed that marker, And then these markers will be in a registry somewhere for all surveyors to be able to find them. It'll have a date when that marker was placed. You can see this one was placed there in originally in 1882. And then it was reset because it probably started to rot out and became unreadable. So it was reset in, what is this, 2013? 2018? This was up in the Adirondacks. This one was placed by the U.S. Geological and Geocodex Survey in 1997. The Army Corps of Engineers, U.S. Coast and Geodeck. And see, they have different things on there. Look, there's a $250 fine or imprisonment if you mess around with these markers. But that was back in 1933 when this one was posted. Still looks pretty good shape for 1933. They just put a little white ink on there so it you can read it better. Right? Hopefully they raised those fines. But back in 1933, $250 was a boatload of money. It's meant to dissuade people from screwing with it. So they should increase these fines tremendously today. I doubt they did. To dissuade people from screwing around with the markers of where somebody's property line is. You know, back at certain times within our country, you could be shot or hung if you mess with somebody's property. Their cattle, let alone their property line. Look, here's another example of a benchmark built into a brick. It tells you that as of this very point right here, you are 348 and 348 feet and 3/4 of a feet above sea level. Here's a marker, another bench marker. Here's another one. Look at this one. They carved it into an actual rock, and they put a marker with some more information there in 1890. So you guys could be out there walking in the woods, going out on a hike. Seems like this was an area of land never touched by man. And then you could see something like this. It was actually plotted out because as our explorers moved out west, as we came to this new land, they started laying out and measuring and mapping out our country. They do it for construction sites. They do these surveys like this. Here's a couple more markers. One right here. Here. Even Disney, they got their custom one with Mickey Mouse. Another one. This is a surveyor marker plate. These are surveyors. Obviously an old picture taken on a piece of tin. This guy's becoming invisible, starting to disappear. Maybe it's like Back to the Future. It's being erased. But even back then, look, they used this scope that they looked through with a tripod, and it was usually at least a two-man team that was used that had great math and mapping skills. So they would measure out the land. They'd have a compass. They'd have these tools here, a chain. A chain was a specific distance and length. So you got a surveyor's chain here. It's either 33 feet in length or 66 feet in length. So the surveyor could give a legal description talking about how many chains the property was. Now, here's some units of measure. These are units of measure used in surveys. An acre, we learned about, because we have to study this and know this by heart, is 43,560 square feet in an acre. A township is 36 square miles or 6 miles squared. Now, 36, now that's not we're talking about a unit of measure here. We're not talking about like Edison Township or Woodbridge Township is 36 square miles. It may be, but that's not, it may or may not be. I don't know. The key here is that that's a different use of the word. When talking about a municipality called a township, that's the form of government structure that was chosen on how they were going to manage that municipality. When talking about measurements as a unit of measurement, a township is 36 square miles. Each one of those square miles is called a section. So how big is a section? 1 square mile. Not that you need to know it, but there's 640 acres in 1 square mile. A chain is 33 feet or 66 feet. The surveyor would spell it out on their survey when they're doing a survey. Okay, but you do need to know for exams, an acre is 43,560 square feet. A township is 36 square miles, and a section is 1 square mile. That you do need to know. Here's some other units of measure. 1 square mile, 640 acres. A hectare is actually 100 meters by 100 meters, which is, it's about 2.5 acres. A lot of other countries use this measurement, hectares. Now we have a lot more modern tools than this today. Our surveying teams usually don't use chains that are stretched out between them to take measurements, you know, with a compass for the direction. They usually do have a compass on their device here at the top, and they use lasers and they have GPS and all that other stuff, but they do it the old-fashioned way as well. So there are 3 legal descriptions of land. Meets and bounds is a measurement of distance and direction around the property's boundaries. It's only used in the 13 original states. New Jersey, we're the 3rd state in the nation. So we're therefore one of the 13 original states. So we do use the meets and bounds measurement of land for legal, as a legal description here. And that legal description is a measurement of meets and bounds, meters and boundaries. So distance and it measures distance and direction around the property's boundaries. Now, the point at which that surveyor begins their measurement is called the POB, which is short for point of beginning. This is a definite designated point at which the measurement begins and ends. So a measurement of distance and direction around a property's boundary lines. The measurement begins and ends at a designated point of beginning. The surveyor's measurement can then proceed clockwise or counterclockwise. It doesn't matter which direction they go, as long as they note which direction they're measuring. And then they have to continue until they finalize their measurement of that property all the way around. You can't stop and then start backing up. You know, you go clockwise or counterclockwise with your measurement all the way around till you close the loop and return to the point of beginning, that which is the start and end point of your measurement around the property. Then monuments are used by these surveyors that they pound these into the ground at each one of the corners of the property. The real estate agent should notify their clients, their buyers, that when they get a survey done, they should find out how much it costs and pay the surveyor the extra money to put those markers, those monuments in the ground. Otherwise, how could you build a shed or put up a fence? You won't know where the actual property line is. They'll give you a survey on paper, but good luck finding where the actual exact property line is. So the real estate agent should advise their clients how much they charge to install them, or to ask how much they charge to install them at each of the corners. I've seen it as little as $75 per marker to as much as $450 per marker. It should be based on the terrain and territory they need to measure. However, that could factor in, But I've seen some regular surveys where you just get surveyors, they charge you through the teeth. They charge you a lot of money for this, and they rip you off. So the attorney usually orders title search and survey. Could the buyer order their own survey? Could they shop around and find a better price? Yeah. So find out before your attorney orders the survey how much they charge. You should advise your client to do that so that you don't get ripped off, or they don't get ripped off. And you got to do that before the survey's done. Now, meets and bounds. Let's highlight the meets and bounds is a legal description used in the 13 original states. And that legal description starts, that measurement starts and ends at a definite designated point called the POB, the point of beginning. And then they bang those monuments, those fixed objects into the ground at each of the corners of the property, so then you could visualize where they are.
Got it.
Okay. Then we have legal descriptions. Okay, legal description. This is the same slide again and again. Then we have the rectangular survey system, also known as the government survey. This is not used in New Jersey or any of the 13 original colonies, the 13 original states. This unit of measure was established by Congress in 1785. Meets and bounds is a much older form of measurement around a property. So this was established by Congress in 1785. It's a measurement that locates the land using principal meridians and baselines that are separated by degrees of latitude and longitude. You guys remember, did you guys have a globe in your classrooms in class when you were in school growing up?
Yeah, I did.
Okay. And did you see they're invisible lines. We don't see them when walking on the planet Earth, but on the globe, they got those lines, you know, like the equator and the meridians, and there's 360 lines all around the sphere, all around that sphere. Some are running east to west, some are running north to south. Okay.
Yeah.
Those are degrees of latitude and longitude. Latitude runs horizontal, longitude runs long ways, you know, up and down. To find areas of land called townships, which are 36 square miles in size. And each one of those squares within those townships are referred to as sections, which are numbered. And each one of them is 1 square mile. So the rectangular government survey method is based on the principal meridians and baselines to locate areas of land called townships and sections. Townships are each identified by reference number. Each township is 36 square miles. Sections are 1 square mile. Each one of them are numbered as well. And sections of townships are numbered 1 through 36. Section 16 is usually reserved for schools and 14 for government use. Let's highlight this.
Got it.
All right. The townships. All right, so in the book on the next page, 353, townships contain 36 square miles. Township, I put a bracket around both townships and sections and wrote these are units of measure. So a township is 36 square miles, a section. There are 36 numbered sections within a township. Each section contains 1 square mile. And here is a picture of a township. I know this not just because it says township here, but because there are 36 numbered ones. And this is the way they number them. They actually start at the upper right-hand corner and count westwardly. 1, 2, 3, 4, 5, 6, then to the right, to the left, to the right, to the left, to the right, to the left, to the right. That's how they measure, or that's how they number the sections within a township. 16, like they said, is usually reserved for governmental use, like the county hall or the city hall, whatever. And section 14 is usually for the school districts. Let me know when you got that.
I got it.
Got it.
Okay. So if we zoom in on that section or that township, we could see that they're numbered from right to left. So you count to the left, count to the right. There's 36 squares. Each one of these squares is how big in size? What do you call each one of these numbered squares?
Sections in the township.
They're called sections. This whole area of land is called a township. It's 36 square miles. Each square is 1 square mile, and it's called a section, and they're individually numbered. The township itself is numbered as well, and it is located by degrees of latitude and longitude on the planet. So here's a zoom in portion of a section, which is 1 square mile. And this is the way that you were to read it. So if you get a question on exam that says, what legal description of land would read the southeast, the SE quarter of the SE quarter, SE stands for southeast. The SE quarter of the SE quarter of the SE quarter is 10 acres in size. The answer would be, this would be the government or rectangular survey. Now, the way you were to measure this is, let me see if I got this. Just pretend for a second here that all this stuff is not filled in. All these descriptions aren't filled in. This is just the outside square. Let's quarter it by drawing a cross through the center. So straight down the center and straight down here. And now you could visually see here's one square, here's another square, here's another square, and another square, right? That's 4 quarters. So the southeast quarter is this lower section. Now let's quarter that by drawing a line straight through that and across. And now you can see 4 squares within that, right? So this is the southeast quarter of the southeast quarter. And then this, you draw a line through that, and there's 4 areas of land as well. This last one here in the corner, that's the SE quarter of the SE quarter of the SE quarter, and this area of land is 10 acres in size. Remember, there's 640 acres in 1 square mile, so this is 10 acres. Not that you need to know that. You only need to know that if you see on exam, what legal description of land reads the SE quarter of the SE quarter of the SE quarter is 10 acres in size, you know it's the government or rectangular survey. Do we use that here in New Jersey? No, we do not. It is used in Western states. So those principal meridians and baselines are used to find areas of land that we call townships. See, if you were to look at the Earth, we got the equator and the prime meridian. The prime meridian is used for time zones. Zero is that's the equator, right? Then we got the meridians that run north and south. The prime meridian is where the time zones are based off of. And they use the degrees of latitude and longitude around the globe to locate these areas of land called townships. Then you zoom in on one of these townships further, and then you could get to something like this and break it down even further. We don't use that here in New Jersey. And lastly, we have a plat of a subdivision. Well, I should add that other description back in there again. Let's copy the slide. And add it again. There we go. So the last legal description is a plat map, a map of a subdivision indicating the location and boundaries of individual properties. The map is recorded in the county where the land is located, right? And each lot is designated by lot and block number within that map. And it's often combined with the meets and bounds legal description because each individual property now, each individual lot is measured starting at a point of beginning, and you measure the distance and direction around each individual property within that plat map. So legal descriptions can be combined by competent surveyors or title attorneys. All right. Now, if you're buying in a subdivision or a condominium, for example, where there could be multiple stories, multiple levels, it's a maybe 3-story condominium. If you were to look at a flat map, you could see where a property is located and its boundaries. Well, that same exact location would be the case for 3 properties. But if you were to make that map 3-dimensional and now start measuring elevation, you could see at what point, at what height does your property begin and end as well. You would need to have that elevation study for the condominium. And that measures the point at where your floors and ceiling are, okay? Now, a measurement of elevation, we call that the datum. Let's back it up a little bit. Remember, a datum is a measurement of elevation. The point line or surface from which elevation is measured according to the USGS is the, so what is zero elevation? In other words, it's the mean sea level in New York Harbor. So here in New Jersey, if we're measuring elevation, we're basing it on sea level in New York Harbor. Yeah, the entire country is. So
that's interesting.
Isn't that interesting? So when you got a surveyor that's measuring your land, I got a house, I just got a survey done. So you tell me that my surveyor went all the way to New York Harbor to take a measurement and worked his way all the way back to my house here in Linden to tell me what my elevation is here? No. But somebody did at one point in time. And now what they did is throughout the town, they put these benchmarks. The benchmark, a local permanent marker that aids surveyors in their measurement, which may be based on them rather than the actual benchmark, which may be miles away. So this local benchmark, which could be near my house somewhere, states on it, as of this point right here, how many feet above sea level you are. So then all he's got to do is measure from that point back to one of the corners of my property. Makes his job easier. But this is how it's done. Because the earth is not flat. The earth is not a perfect sphere. The earth isn't round. We have mountains and we got valleys. So they got to do the measurement of elevation and base it off of some kind of baseline. That baseline is the sea level at New York Harbor, because that basically has not changed. You know, I know people are always saying, oh, sea levels are rising. Oh, yeah, well, you know, some places they're rising, some places they're falling, you know. But on average, the average sea level in New York has been the same. So that's a lot of hysteria that's been pushed by these climate change activists, and it's not really based on any science. And science, and people who say that science is established and science is settled, they're not real scientists, because that's not true. Science is always a debate. It's always an argument. It's always evolving. It's always changing. So the plate, the plate. What is a plate? It's not a plate. It's a plat. Plots on a plat. They probably spell check did that, I'm guessing. Plat is a map of a subdivision to locate individual properties by lot and block number and combines the meets and bounds measurement of each individual property's boundaries. The description of land designated by lot and block number in order to locate on that subdivision map. And then plat map of a subdivision is further then measured each property. You measure the distance and direction around it. That is meets and bounds. And for condominiums, well, you'd have to measure the datum, the elevation. Also, maybe it's not a condominium. Maybe you just want to know the elevation of your property so that you don't have to pay for flood insurance. Because once again, if you were to look at a flat map and it shows that there's a river that runs right through your property, well, you're in a flood zone. Are you? Maybe that river is 300 feet down and I'm very elevated. Well, you'd have to get an elevation study done by a surveyor that proves that. Otherwise, you got to get flood insurance. So here's one example of a plat map in our book. There's another one. So there's one on page 341, 354, which is this one. And then there's another one on page 370. So here's the one on 341 that we went over. Remember this one? And look, it shows you the not only is this the plat map of a subdivision, each property is individually numbered 1, 2, 3, 4, and then there's a measurement around each property. You know, 100 feet by 70 by 100. That's the meets and bounds legal description. Only there's not a POB for each one described here because there's not. This is just the plat map. This is not an individual survey of the property. That's where you would see the POB. So surveys are done by licensed surveyors. These are professional map makers. They're very good at math. There's a lot of math they got to do. And they've got these drawing skills to be able to measure the properties, to survey the land, as well as drawing the maps. All right. Condominium descriptions, they measure elevation. We already spoke about that to find out where your property begins and ends, or to see if you're in a flood zone or not. That's where you use the datum. What is a datum? Datum, however they pronounce it. It's a measurement of elevation. And what is zero elevation? The mean sea level at New York Harbor as defined by the USGS. That's the United States Geological Survey. That's a department of government that monitors our planet Earth. Often you may watch the news on TV and see the satellite of storms coming in, storm fronts moving in, right? Some news agencies that don't have their own satellites in space, they actually get that imagery from the USGS. So somewhere in the corner on those maps, or underneath it, you'll see a little text that says, provide satellite imagery or something. It'll have the USGS logo on it. Because the USGS monitors our planet. They monitor our planet from outer space, from look at any foreign objects are in danger of hitting our planet, to they look at our planet, they monitor seismic activity for earthquakes, for volcanic activity, for they monitor the oceans to look for if there's going to be a tsunami or shifting of the tectonic plates that causes those tsunamis and such. They monitor our planet. The rising and lowering of sea levels. They monitor the planet. So the datum, you guys have this highlighted, page 355?
Yeah, I got it.
And what about benchmark?
Yep.
Paragraph just below it. Okay. And once again, the total thing about what you need to know. Benchmark, datum, monument, needs to know. They could ask you a question about what legal description of land is used in New Jersey and the 13 original colonies only, the 13 original states only. Meets and bounds. What legal description of land has its measurement commence and end at a definite designated point called the POB? Meets and bounds. What do you call the point at which, what do you call it, the location where the measurement of a meets and bounds measurement begins and ends? It's called the POB. See how they could ask questions? What legal description of land is used in Western states? The rectangular or government survey. What legal description of land uses degrees of latitude and longitude to locate areas of land called townships? Rectangular or government survey. What legal description of land was established by Congress in 1785? The government or rectangular survey. What legal description of land is used to locate areas of land called townships and sections? The rectangular or government survey. Right? What is an area of land that's 36 miles squared? Township. And what is 1 mile squared measurement of land called? Section. What do we call a map of a subdivision that indicates the location of the individual properties and their boundaries? Plat map. Okay. Now we're going to talk about deeds, the second half of this chapter. We're going to talk about the anatomy of a deed. We're going to talk about deeds and the different types of deeds. So a deed is a written document. It's a written instrument, another word for document. A deed is a written instrument where an owner of real estate intentionally conveys their rights, title, or interests in a parcel of real estate. That's what a deed is. Deed is a written instrument where an owner of real estate intentionally conveys their rights, like their air rights or their mineral rights, or their title, their ownership, or interests. That would be like a partial ownership in a parcel of real estate. Now let's talk about the parties to a deed. The grantor is the one who sells or gives the land. The grantee is the buyer or the one who acquires the title. Now, in order for a deed to be valid, the grantor must sign the deed. The signature of the grantee, the buyer, is not required to make a deed valid, but it needs to be signed before they can record it. Before they can record it. in the public records. Deeds don't need to be dated. Deeds don't need to be dated because transfer of ownership takes place upon delivery and acceptance of the deed itself. And deeds must be signed and dated and the signatures acknowledged by all parties before it can be recorded in the public record. Okay, so let's see. The signature of the grantee, the buyer, is not required to make a deed valid, but the grantee must be named in the deed. Deeds don't need to be dated because transfer of ownership takes place upon delivery and acceptance of the deed itself. Deeds must be signed and dated and the signatures acknowledged by all the parties before it can be recorded in the public record. What is an acknowledgement? That's another question. It's going to come up on another slide, but it's basically confirming that the signature is genuine because somebody checked your ID or they know who you are and they witnessed your signing of the document. So deeds are valid even if not recorded in the public record. It is, however, in the buyer's and the seller's best interest to ensure recording it, their interest. So basically, if I have a deed, here, let me get a piece of paper out, I want to have the garbage here. So if I have a deed, this document is a deed, okay? If I have a deed that I'm holding here in my hand, and I sign it, and I'm the owner of the property, and I have all the rights and interest in that property, and I sign that deed, and I name you as being the buyer who I'm granting the ownership to in that deed, and I give it to you. The moment that you take it and accept that deed in your hand, you became the owner of the property. You didn't need to record it. You're the owner now. You accepted the deed. You didn't sign it, but you're named in it, and I'm the seller, and I signed it, and I handed it to you. You're now in possession of that property. You're seized of the land. It's in your control, that paper that says that you're the owner. However, it's in your best interest to record that interest. Why do we record any document in the public record? Why do we record any document in the public record? It puts the world on notice of our interest in that property. So because I'm in possession of this paper, this deed, I'm now the owner because I'm in possession of this document. But the rest of the world doesn't know that. So if somebody trips and falls on that property, who are they going to sue? The person who's listed in the public record as the owner, and that's the previous guy who just gave me this deed. So is it in his best interest to ensure that I record my ownership interest now as the new owner of the property? Yeah.
Yes.
Why would it be in my best interest as the new owner to record it, though? Well, what if somebody sues him and then they find out any property that he owns? They could take that lawsuit judgment and make a lien on any property against any property that he owns. And if he's still listed as the owner of this property, they could put a lien on the property that he's still listed as the owner as. So if I take this deed and I record it in a public record, he no longer is showing as the current owner, so they can't attach a lien to the property. So those are two good reasons. And another one is also to protect my interest. Because if that guy who sold me the property is not very scrupulous, he could take another one of these blank deeds and name somebody else as the buyer in it and sell the property to someone else that same day. Now there's two deeds floating around with two different owners on them. Who's the owner? Am I the owner? Because I signed it in the morning? Or is the other guy the owner? I mean, there's no time stamp on this deed or no date because the transfer of ownership took place upon delivery and acceptance of the paper. So who's the owner? Well, now the race is on. Whoever gets to the county hall of records and records their deed first, they're the owner. The other person, good for nothing. Now you need to find who sold it to you and get your money back. Good luck. That's the way it works. Now, four types of deeds are commonly used in New Jersey. We have the full covenant and warranty deed, the bargain and sale deed with covenants against Grantors Act, the bargain and sale deed without any covenants. A covenant's a legal promise, if you recall, and a quitclaim deed. So let's highlight that a deed is a written instrument which an owner of real estate intentionally conveys their right, title, or interest in a parcel of real estate. The owner who sells or gives the land is referred to as the grantor. They're granting their ownership. And the new owner who acquires that land is called the grantee. If you guys recall legal terminology, words that end in OR is the one who's giving, the words that end in EE is the one that's receiving, and we transfer our ownership by grant. So the grantor is the seller, the grantee is the buyer. And there are four types of deeds commonly used in New Jersey. And here are the four types of deeds in rank from those who offer the most protection to those that offer the least protection to the buyer. So the one that offers the most protection is the full covenant and warranty deed. It comes with a full warranty. Now, what does that mean? We're going to go over that in the coming slides. For now, just do these highlights and take these notes. Once you got it down, we'll move on to the next slide and I'll explain it to you.
Got it. Pretty sure we highlighted this earlier too.
What's that?
Pretty sure we highlighted this earlier too.
Did you? No, we may have skipped ahead. We may have skipped ahead and I mentioned a couple of things to you. I had you highlight some of these items as well. So we may have discussed this a little bit, like explaining the four types of deeds, but I think we were really discussing the four proofs of ownership or the four evidences of title. Because a deed is not evidence of ownership, or it's not proof of ownership. But we're going to get into that a little bit later. But we did go over that in earlier chapters as well. We skipped forward. So these are the four proofs of these are not the four proofs of ownership. These are the four types of deeds that are used to transfer ownership. The full warranty deed, the bargain and sale deed with some promises, the bargain and sale deed without any promises, and the quitclaim deed. So here's a slide that makes that just a little bit neater for you. It also tells you what these deeds, alternate names that they go by. We have the warranty deed is also known as the general warranty or full covenant and warranty deed. Covenant is legal promise, so it's a fully legal promise or full warranty deed. Then we have the bargain and sale deed, the CAG. It's called the bargain and sale CAG. That stands for Covenants Against Grantors Act. Some people say in covenants against, some people say covenants versus. It means the same thing. It's a bargain and sale CAG or bargain and sale CVG. There are two ways of saying the same thing. Like, have you ever seen like a lawsuit, a document where it says this person against the defendant, this person? But then sometimes those documents say this person versus this person. It's the same thing, So bargain and sale CAG or bargain and sale CVG deed is very different than if you just have the words bargain and sale deed, because that's a different type of deed altogether down here we're going to go over. So the bargain and sales deed with covenants could also be referred to as the special warranty or limited warranty deed. In this type of deed, the owner is saying, we'll go over each one of these deeds. Let me give you a quick rundown really quick. The general warranty deed or full warranty deed is saying that if you buy this property for me, I guarantee that this property is free of any liens or encumbrances other than those that I may have already disclosed to you. That neither I or anybody throughout history that has ever owned this property before me has in any way, shape, or form ever encumbered this property. That's a lofty promise to make, but that's the promise that's coming with a full warranty deed. In a bargain and sale CAG type deed, me as the owner, the grantor, I'm just saying that if, as long as I've owned this property, I have done nothing to encumber it. I'm not guaranteeing anybody that's owned it before me. For that, do your own title search, do your own due diligence, and find that out. Okay? That's why it's a special or limited warranty. I'm only granting that during the time I owned it, I did nothing to encumber it. I don't know about anybody before me. You know, I did a title search, it didn't come up with anything, but I'm not guaranteeing that. And then we have lastly, not lastly, and then we have a bargain and sale deed without any covenants. It's just the straight bargain and sale deed. There's no CAG or CVG after the words bargain and sale. It's a totally different deed. So don't get lazy when you mean to say bargain and sale CAG deed and just say bargain and sale deed, because it's a totally different deed. It's a straight bargain and sale deed without any covenants. These are often used in sheriff's auctions and tax auctions, where the municipality is just saying, "Hey, we're giving you the sheriff's department is saying, hey, listen, we got the legal right to sell the property. We're not guaranteeing the quality of the title. We're just saying that we have the right to sell it." And then the quitclaim deed's not even saying that. A quitclaim deed, somebody is just giving up their rights or interest in a property without ever admitting whether they actually have any rights or interest in the property. But a quitclaim deed can just as effectively transfer the ownership of real estate as a full warranty deed can. The only difference is you're not making any guarantees as to the quality of that title. You're just quitting any claim of interest in that property. Kind of like a gold miner. They think the claim is no good anymore. There's no more gold. It's all been extracted from the ground. So they say, damn, I'm quitting this claim. They're giving up any interest in the property. They're not actually claiming they ever had interest to begin with. They're just giving up any interest in the property. All right, so let's go over each one of these in a little more detail. In a full warranty deed, what is this full warranty? What are all these legal promises that are being made? Well, you could follow along with this on page 356. We have the covenant. Now, you don't need to study this or memorize all these different claims. We're just going to go over it so you have a better understanding of what actually gets transferred with a full warranty deed. And it's kind of nutty because let's go over all of them. We have the covenant of seizin. It's said that you're seized of the land when you're in possession of it. So the grantor warrants that they're the owner of the property and they have the right to convey title to it. They're in possession or seized of the land. It's their property. Then the covenant against encumbrances, that the grantor warrants that the property is free from any liens or encumbrances and they're willing to defend it. An encumbrance, remember, is a claim or other liability against real estate, such as taxes, judgments, liens, restrictive covenants, easements, licenses that could diminish the value of the property, the value that could diminish the use or value of the property, which the grantee buyer was not made aware of. Let me put that word use in there. That could diminish the use or value of property which the grantee, the buyer, was not made aware of. When you buy a property, you want to know if there's going to be restrictions on it, right? On how you could use it. The covenant of quiet enjoyment. This is a guarantee that the title is good against any third parties who may step forward and make a claim of ownership or interest in that property. The covenant of further assurance. The grantor promises to obtain any documents that are needed in order to make the title good, to produce evidence in court, basically, to defend the ownership. And the covenant of warranty forever that states that if these promises ever fail now or in the future, that the grantor will reimburse the grantee for any losses that they sustain for the money that they laid out to purchase the property or that they put into it. Now, here's the wild part. These covenants are not limited to matters that occurred during the time that the grantor owned the property, but they extend back to all previous owners that have ever owned this property throughout history. That's a lofty claim to make.
They would have to do research on that, right?
How would you even prove it? I mean, how could you do research on that? I mean, the public records only go back so far. I mean, our country, when did the United States become a state? You know, going back since the beginning of time of our founding. I'm guaranteeing that since then, there was no improper transfers of ownership. When did New Jersey become a state? What's 17 something? What's the seal of New Jersey say? So, hey, Google, what year did New Jersey become a state?
New Jersey was granted statehood on the 18th of December, 1787.
1787. So I'm guaranteeing that since 1787, the year of 1787, that there was never any improper transfers since then, or any partial transfers where one of the owners did not sign off on it. How can you? That's a lofty claim to make. I hope they have all those detailed records in the County Hall of Records dating all the way back to then. I hope that City Hall never burned down, or that the County Hall of Records had never burned down since then with all them property records, or got flooded out, or any of those documents lost. So let's highlight here the warranty deed, also known as the general warranty or full covenant and warranty deed, provides the greatest protection of any deed. Then we have the bargain and sale deed with covenants against Grantors Act. In the book first, let's turn the page. Here's a blank full warranty deed provided by Allstate Legal Services, which is based in Cranford, right down the street from me, actually. They're about a mile away from me. And then we have the page 359. We got the bargain and sale deed with covenants against Grantors Act, which we're going to highlight these highlights right here from page 359. In this type of deed, the bargain and sale with covenants against grantors, also known as the bargain and sale CAG or bargain and sale CVG type deed, the seller, the grantor, is willing to warrant or guarantee about the time that they own the property, that they've done nothing to encumber it during their ownership. There's no previous owners or ownership is warranted prior to the seller's ownership. So the grantor is willing to warrant about the time they own the property. Here, let's put this in plain English. Let's dumb this down a little bit, make it easier to study, right? So the bargain and sale deed with CAG, the grantor is willing to warrant / guarantee that they have done nothing to encumber the property while they owned it. No previous owner's ownership there. No guarantees are made that any previous owners haven't encumbered the property. So the current owner states that they have done nothing to encumber the property while it was in their possession only. Sometimes called a special or limited warranty deed. It's the most commonly used deed in New Jersey, plus title insurance policy. So most people, they'll get a bargain and sale deed with Covenants Against Grantors Act, where the seller says, I've done nothing to encumber the property while I've been the owner. As far as anybody that owned the property before that, get a title insurance policy, do a title search and get title insurance to protect you from that. And that's what we do here in New Jersey. And then we have the straight bargain and sale deed. Turn the page. The page 361, do this highlight here. There are no express warranties. However, it does imply that the grantor holds the right to title to the property, so they have the right to sell it. So the bargain and sale deed, also known as a straight bargain and sale deed without any covenants, the seller only says they have the right to convey ownership. They're not making any other promises. There's no express warranties as to the quality of the title. The grantee, the buyer, has little recourse if defects appear later. So caveat emptor, that is not pronounced caveat emptor, it's pronounced caveat emptor, another term you need to know in Latin. It means let the buyer beware. Do your own due diligence before you buy a property. Do your own research before you buy a property. That's what caveat emptor means. Let the buyer beware.
Got it.
Can you hear me?
I hear you.
Okay. Something flashed up on my screen that my device is not working, that nobody can hear me. Okay. So you can hear me though, right?
Yeah.
Okay. So caveat emptor means let the buyer beware. Do your own research if you want to find out if there's a problem with the property. Now, this type of deed is often used in sheriff sales, foreclosures, and tax sales. Even though when you buy a property at a tax sale, you don't get a deed. You have to actually foreclose on the owner, which you got 2 years. They got 2 years to redeem that property back and pay you back all the money. But if you do foreclose, you get a bargain and sale deed. It basically says that there are that you got that property, but it's not, the town is not guaranteeing, or the court's not guaranteeing the quality of title. They're just transferring that ownership to you. Even though when you buy a property at a tax sale, it wipes out all other liens. But that doesn't mean that sometime previously in the future, there was an improper transfer of ownership and somebody can't step forward and claim that they're the rightful owner. Okay. I actually just met I met some girl the other day. We did a motorcycle run for a charity in Woodbridge the other day. I was introduced to this one girl who wanted to get her real estate license, but she just found out that she's the owner of a piece of property and she didn't even know it. She just found out. So when her grandmother died, she left her the property, but she didn't even know it. She didn't even know about it. And somebody else was paying the, paid the taxes on it. But the guy never did a tax foreclosure or anything. And he's trying to claim ownership of the property and sell it and build on it. But she's got all these lawyers coming at her, wanting her to sign paperwork and before they do anything. because they know that she's got a financial interest in the property, and that's what alerted her to the fact that she owns the property and that she has an interest in this property here that this guy's trying to sell out from under her. Which it's an interesting but complicated story because there's a lot of details to it. I will not get into those here, but can somebody make a claim of ownership on a property? Well, yeah, that all depends. Now, lastly, we have the quitclaim deed. A quitclaim deed, you're not even claiming that you're the owner or that you have any interest in the ownership of a property. You're only saying you have the right to, you're not even claiming you have the right to sell the property. You're not claiming any rights or interest in the property. You're just saying, I'm giving up my interest in this property. You want to pay me to give up my rights and interest in this property? I'll do that. But I'm not saying that I even have any interest. But if you want to pay me to give up my rights, that's like getting me to sign away my rights and interest to your house that you own. I don't have any rights or interest in that house, but if you're willing to pay me to give up my rights or interest in your property, sure, I'll sign a quitclaim deed. But you can't come after me later and try to sue me and say, wait a minute, I paid you to sign the deed to for you to give away your interest in this property, and you never had any interest. Well, I never made a claim that I had any. You wanted to pay me to sign away my interest in the property, so I did. But I didn't make a claim that I had any to begin with. So you can't really come after me to try to get your money back because I never made such a claim. However, a quitclaim deed can just effectively transfer that ownership right as a full warranty deed if I did have all the rights and interest in the property. So a quitclaim deed provides the least amount of protection of any deed. It carries no covenants or warranties whatsoever. It does not imply the person signing it has ownership or any rights or interest in the property. Only that they're giving up any possible claim of interest that they may have in the property without saying that they actually do have any interest in the property. Does that make sense?
Yeah, it does.
Okay. So it doesn't claim that the grantor has any interest in the property to begin with. You're just asking them to sign away their rights to the property. Now, it's the most oftenly used for simple transfers of ownership within family, but it could also be used during divorce settlements or to clear up clouds on a title. Remember when I said cloud on the title, to think of a dark thunderstorm cloud hovering just over your house? So if you search the public records and you can't link ownership from one property owner to the next, this actually creates a cloud on the title. We need to clear up that cloud by finding out the paperwork of how did you get ownership of it? Because it shows that this guy owned the property, but then the next time that we see that there's a ownership, it's you. But we know that this guy sold it to someone else. You didn't get it from that person, so who was the owner in between? That creates a cloud on the title. It's a gap in the chain. Somebody didn't record their interest in the public record. Not that they had to, but it's best that they do. Because now when you do title searches in the future, these things can be easily verified that there were no improper transfers. Otherwise, it makes it a mess, and it could take a while to clear up. So a quitclaim deed can transfer ownership just as effectively as a full warranty deed, if the grantor, the seller, had the good title or interest in to grant or sell the property to begin with. So you guys highlight this and this?
Yeah, about it.
Yes.
Okay. So what is the requirements to convey the ownership? So we're going to go over the parts of a deed. So the anatomy of a deed. So the grantor legal capacity to execute or sign the deed. So the grantor has to have legal capacity to sign the deed. Just like any contract, you got to be sound mind, legal age, right? The grantee, the buyer, has to be named in the deed with reasonable certainty that they could be readily identified. There has to be some sort of consideration expressed. That's the full purchase price. Then the granting clause is the heart of any deed. It's the meat and potatoes of the deed, so to speak. It expresses what exactly is what's going on here. Who's transferring what, who's taking ownership. And then the habendum clause is when anything mentioned in the granting clause needs some further clarification. It gets clarified in the habendum clause. And then the legal description of the real estate. What are the three legal descriptions of land we just went over? Meets and bound, government survey or rectangular survey, and a plat map. So deeds do not have to be dated in order to be valid or signed by the buyer, unless they try to record that deed in the public records. And you should record your deeds as soon as possible. So let's highlight that deeds do not have to be dated in order to be valid and right there or signed by the buyer, unless they want to record it.
Got it.
Okay. All set?
Got it.
Now, in this slide, you guys may want to snap a picture of this one. There's another one of my highly customized slides that do not come from the book manufacturer, where I give a full description about this, all of these parts here and what exactly they do. So you could read this on your own and you could study and learn all of these terms that you're going to need to know for exam. The grantor, well, who's that? That's the seller. You got to be 18 years of age or older and a sound mind in order to execute that deed. The grantee has to be named in the deed so that they could be identified with reasonable certainty of who they are. There has to be the consideration expressed. To be valid, all deeds, like any contract, must acknowledge a receipt of something that was given in exchange. That's the consideration. So something of value exchanged between the parties. Legal tender, that's money or a mortgage loan. Fair exchange of goods or services, or love and affection. But if it's love and affection, consideration of $1 or love and affection should be accompanied by an affidavit, which is a sworn statement explaining that the transaction is a gift. Then the granting clause, which is the heart of any deed, explains the type of deed, what is being transferred, title, rights, or interest, or partial ownership interests. It could be what type of tenancy? Is it a tenancy in severalty, tenancy in common, joint tenancy, or tenancy by the entirety? That would all be placed in the granting clause. Now, if you do not specify in the deed, if you and I are buying a property together, we're not married. We're buying a property together. I put up 50% of the cash and you put up 50% of the cash. We're 50-50 owners. Now, if we buy the property and I put up 75% of the cash and you only put up 25% of the cash, we're still 50-50 owners unless I make it a point to specify it in the deed, to ensure that it's specified in the deed that we're 50-50 owners. If we don't write that in the deed, that I'm 75% owner and you're 25%, we're 50-50 owners, even though I put up 75% of the cash. So we would make sure that that is specified, the type of ownership and the what kind of ownership is being transferred exactly. So habendum clause follows the granting clause, and it begins with the words to have and to hold. And its provisions must match up with those in the granting clause. And it specifies things stated in the granting clause that require further clarification, like percentage of your ownership, if several owners do not have the equal shares, or if you wanted to name a remainder man, if it's a life estate. That would need to be explained in the habendum clause. So whatever's written in the habendum clause cannot be contradictory to what is there in the granting clause. The habendum clause just supports and further clarifies information that was in the granting clause. Now, the kinds of questions that you may get on exam for this, they don't even require you to know that. Last I heard, the questions that they gave were kind of stupid. You just needed to know that the habendum clause follows the granting clause and begins with the words to have and to hold. Why would that be of any interest, and who would care? So I call the habendum clause, I'm going to do a little mispronunciation here to remember this. Habendum clause begins with the words to have and to hold. So I refer to it as the have-been-to-hold clause. The habendum clause is the have-been-to-hold clause. It begins with the words to have and to hold. Now, the description of the real estate, there are 3 legal descriptions of land, and they need to be stated here. Either meets and bounds, a rectangular or government survey, or the plat map needs to be described here in the survey, or I'm sorry, in the deed, and or attached to the deed. Shoot, I should have scanned and showed you guys my old the deed for the house. I got my parents' deed for the house, and it shows that they in their deed it shows the survey was actually not just referenced to in the deed, it was actually written into the deed itself, the surveyor's description. They actually even wrote it into the sales contract, which is weird, but that's old. Anyway, although a lot and block number and address are helpful in describing property, they're not legal descriptions of land. Did you know that your post office can change the address of your property?
I didn't know that.
So it can't be considered a legal description, because what would that do to your deed? What, now you own the property next door and not the one that you're living in because your address changed? So an address is just a way to route the mail. It could be useful and helpful in finding your property, but it's not considered a legal description. Only the explanations by a competent surveyor are considered legal descriptions. And even though we use lot and block numbers on tax maps, they're not legal descriptions either, but they could be used to locate your property too. And they'd probably be closer to a legal description than your property address would. But yeah, I've actually seen this happen once in Elizabeth. They tore a house down and they built 2 houses there. So instead of just like having, let's just say that it was block number 500, lot number 20, instead of giving the new house that was built on that lot, they subdivided it. Instead of then calling it lot 20A and 20B, or just lot 20 and then 20A, they shifted the addresses on all the properties. Forget about the lot and block number. They shifted the address for every house. So let's just say that the previous, I mixed up lot and block number there. I'm sorry about that. Let's just say the previous address on the house was 500 Main Street. Instead of making the next home that they built 500B Main Street, they made it 501 Main Street. But the neighbor that was already 501 is shifted down. So all the houses on that block had their address changed. They all had them shifted down. Now that sounds very intrusive and very screwed up, because now people got to change it on their bills. They got to change it on their driver's licenses. That's a big major disruptive change that they made. But I've seen it done before. And your post office can change your address. I don't know why the hell they did that. I mean, they could easily have just added in a letter to a number there, or given it an additional number without, it could have been 500 Main Street, and now it's 500-1 Main Street. You know, instead of shifting all the numbers down. But that's the way they did it. Now, exceptions and reservations. Any restriction in a deed by private parties are called restrictive covenants. We also went over that again in the last chapter. So restrictive covenants are added into the deeds themselves. And any estate in land, estate is a description of people's interest in real property, but a estate in land that's based on a restriction is called fee determinable, defeasible, or conditional fee estate. And this was, we went over this on page 104 in the book. Is fee determinable, defeasible fee, or conditional fee estate, which can be found on page 104. There we go. And then a deed has to be signed by the grantor, the seller. They don't need to date the deed because the deed is the ownership is transferred upon delivery and acceptance of the deed itself. But before a buyer can register the deed in the public records, they have to acknowledge. They have to sign the deed and have their signature acknowledged. What is an acknowledgement? It's providing evidence that the signature is genuine, that basically a person who's witnessing you signing the document knows who you are, or they checked your identification to verify who you were before you signed it. The purpose of this is to prevent forgeries. And the witness would be a notary, a judge, attorney, or other trusted public official, like an elected politician, because they're so trusted, right? All right. Now, requirements to convey the property, accession. Okay, so we already just went over all this in my one slide. So consideration. Let's highlight affidavit or sworn. Affidavit is a sworn statement. Now, if you want to also highlight here, because you're not going to use the notes that on the slide that I used, if you're just going to study from the book, consideration is defined as something of value offered by one party and accepted by another as an inducement to perform or refrain from performing some legal act. Consideration must be good and valuable between the parties. I guess you could highlight that. But an affidavit is a sworn statement. Consideration is the full purchase price. It's what the parties give or receive from each other in that exchange. So if you're not going to use my other slide, then just right next to consideration, it's the full purchase price.
Got it.
Affidavit, you need to know, is a sworn statement. The habendum clause, we already went over this, and on my slide, we had all the definitions, but if you're going to study from the book, highlight habendum clause, you know, and make all of these notes here. All this stuff was on that one slide of mine. This says further clarifies terms stated in the granting clause, like percentage of ownership or naming a remainder man. Restrictive covenants, fee eternal, defeasible fee. There you go. I'll give you guys a moment to write all that stuff down.
Got it.
Got it.
You got it too?
I got it.
Okay. And then you have to have the signature of the grantor. That's the seller as well. Now, here's a little interesting fact. What if the seller, or for that matter, the buyer, they can't show up to the closing for whatever reason? Maybe they scheduled a vacation to happen and they paid for a vacation and the dates were shifted around on the closing, and now it's going to take place when they're going to be away on vacation. They can have somebody sign the documents on their behalf to purchase the property by giving a power of attorney to them. But here's an interesting fact. Do you know that a power of attorney, if you grant somebody a power of attorney to sign documents on your behalf, that's only valid while you're alive? So to ensure that somebody was alive when someone else had a power of attorney to sign documents on your behalf, after the date where they signed those documents, the person who granted that power of attorney to somebody else should sign a document in front of a notary that says that they have appeared on this date before them. And that's it. That would prove that you were alive. So that should be recorded in the public records along with the power of attorney, along with any documents that they signed. Because if you were to do a title search and they see that, well, somebody signed these documents that wasn't the buyer here. Why did they sign these documents? Well, they were granted a power of attorney, and then here's the paperwork that shows that the person who granted them that power of attorney was alive. So it was valid. So you got to do a lot of tracing and verification and proving of paperwork, right? Hey, stuff got to be accurate so people can't fudge the truth. I wish government was so thorough and efficient when monitoring politicians, don't you, and their behaviors and their actions?
Yeah, I definitely do.
I mean, these rules that they impose on us, you know, it's pretty straightforward. How come they don't hold themselves to the same flame, you know? So an acknowledgement. Here we go. Let's do these highlights. What is an acknowledgement? It's a declaration made by a person who's signing a document before a notary public or authorized public officer. The acknowledgement provides evidence that the signature is genuine to prevent forgeries. And although an acknowledgement is not required to make a deed valid, in New Jersey, all deeds, mortgages, and similar documents have to be acknowledged before they can be added into the public record, before they can be recorded. So what's an acknowledgement? It's just somebody verifying who you are before you can sign a document. The purpose is to prevent forgeries, right?
Yep,
Do you guys get all this?
got it.
All right, so what's an affidavit? All these A words, acknowledgement, affidavit. You see, a lot of it is terminology. Here, let's back it up a bit. There we go. An affidavit is a sworn statement. An acknowledgement is somebody verifying your signature to prevent forgeries. Now, delivery and acceptance. I told you the story already, why it's important, or when does the transfer of ownership take place? Upon delivery and acceptance of the deed itself. But because the deed was delivered and you accepted it, that proves that you're the, because the deed was delivered and you accepted it, that's the moment where the transfer of ownership took place. That's why deeds do not need to be dated or signed by the buyer. However, deeds do need to be acknowledged before they could be recorded in the public records. Now, this is an interesting little story here. How did the transfer of ownership take place in the Middle Ages, when very few people were literate? That means they didn't know how to read or write. Think about that for a second. How do you transfer ownership of real estate if the people don't know how to read or write?
Word of mouth, like just saying.
It can't be done by a document. I mean,
Basically, you're just telling them, right?
can you hear me again?
I hear you, I hear you.
Okay, sorry, that document that cut out on me again, the audio. So the even though I was putting my camera on, I don't know why that. Okay, so even though the person cannot read or write, on documents sometimes you could put your X on there if it's verified that somebody has read you the documents. You could put your X there to confirm that they did, and then maybe someone else should verify and sign that you did really read it to them. And I guess you can then legally sign documents that way, but that's kind of a lot of additional paperwork on that as well. But I guess that's how you could do it today. Maybe your legal representative would be able to do that. But think about it. How do you transfer ownership of real estate? Well, in the Middle Ages, very few people knew how to read or write, so it wouldn't be built by a document. What would happen is, let's read the story. And you guys remember Schoolhouse Rock, or are you too young for that? Did you see that on TV when you were a kid? There used to be these PSA, these public service announcements. They're basically after school commercials. They were like little cartoons for kids. Sometimes they were like a half hour long, explaining or 10, 15 minutes long, and they'd be a cartoon that would explain to you some kind of a learning lesson, like conjunction, junction, what's your function? What is a bit?
Yes, I know what you're talking about.
Those things that taught you. I don't know why my camera and microphone. You guys can hear me again?
Yeah.
Yes.
I don't know. You can hear me now, right? So let's read this. Let's read this. This will describe. You guys can hear me right now, right?
Yeah, I hear you.
Okay. So in England during the Middle Ages, I'm going to do it in one of those cartoonish voices like they did with the What is a Bill? You could picture a little cartoon characters and close your eyes and just picture what's going on as I read this to you. In England during the Middle Ages, when few people were literate, the transfer of title occurred in the following manner. The seller took the buyer to the field in question, and they walked the boundaries. This was known as the beating of the bounds. Then the seller reached down, and they took up a clod of earth in their hands that represented the whole field in question. They handed that clod to the buyer. The moment that they handed that clod of earth to the buyer, they became the owner of the land. Today, a document is used instead of a clod of earth, but titles said to transfer at the moment of delivery and acceptance, and the owner is still said to be seized of the property. So the word season still denotes ownership and control. So we heard that word season a couple of times when we were reading about all the different types of guarantees that are made in a full warranty deed, right? But season, the word season denotes ownership and control because you're seized of the land that is in your possession. You are the owner. You have all the rights to ownership. You've seized that land. Hell, even when you conquer land, when kings and queens and emperors, right? They seize the land. What does that mean? It's in their control. It's their property. So the word season still denotes ownership and control today. But that's interesting. So they walked you around the boundary lines of the property, pointing out where your property's property line is. Then they picked up a piece of the dirt and they stuck it in your hand. They're like, boom, you're now the owner. Late. Interesting, huh? Well, see, that could make things kind of difficult to transfer ownership, though. And people can get screwed out of ownership because they could say, well, I'm the owner. And you're like, well, no, I'm the owner. What are you going to do? Pick out a piece of dirt that you have in a cup inside your house and say, see, the dirt, I'm in control of the dirt. Yeah. How do you
back then people probably fought over that, I imagine.
Oh, you can imagine, absolutely. Well, that's why they called them the medieval times, the medieval ages. People were always fighting and sword fighting and doing all kinds of stuff, right? You could imagine the kind of treachery that would take place with this, right? So,
Right.
wow. Those were some hard times back then. I mean, we think about the music and how they ate and they roughed it a little bit, and times were simpler, but they were also a lot harder. But you see how the rich and the powerful kept their control back then, though, in the medieval times?
Yeah.
They kept people stupid. You were not allowed to learn to read in some places. Why do you need to learn to read? You're always going to be the servant. You're always going to be a maid. A dumbed down population is easy to control. And that stands true today. And we see politicians today even trying to exercise that. And nothing has changed since the Middle Ages. They just changed their approach on how they do it. Kind of sad, but kind of eye-opening too, let's see. So how do execution of corporate deeds work? Well, if a corporation owns real estate, who makes all the major financial decisions in a corporation to buy and sell that real estate?
Board of directors.
There you go. It's passed by it's a resolution, which is a document that's going to be signed after it's voted on by the board of directors. So they pass these resolutions, and then they'll sign off on that resolution agreeing to the sale. It's not the president or CEO that signs off on that. Those major decisions need to be run by the board members, which look out for their shareholders. And then they give the authorization to sell or buy the property. And only an authorized officer can sign deeds to real estate. So the board of directors is going to authorize somebody to sign on behalf of the corporation to sell that property. So that you don't got to have a bunch of people, everybody from the board of directors got to come down and sign it. They're going to give that authorization to one person. So let's highlight a corporation on page 364. A corporation can convey real estate only upon a proper resolution passed by its board of directors. And that's it for chapter 19. So We're going to go over the key terms to review. I'm going to update the few changes that I made there to that slideshow in the shared Google Drive. Chapter 19, we delete that and replace it with the new slide. Updated. All right, gang, so let's do the key terms to review for chapter 19. There are two of them. Page 366. One who receives property through a deed. What do we call them?
Grantee.
The grantee. 9 is A. A deed implying the grantor owns the property. What kind of deed implies the grantor owns the property, but nothing more? You know what? Next to letter B, it says deed implying the grantor owns the property. Right, but nothing more. Nothing more. So what kind of deed implies the grantor owns the property, but nothing more? Doesn't make any other promises.
Bargain and sale deed.
Yeah, straight bargain and sale deed. They're not giving any other promises or guarantees. 2 is B. Actions that actually transfer the title.
Delivery and acceptance.
Yeah, just what's the story about it? The delivery and acceptance of the deed itself instead of a clod of earth. So 8 is C. A clause in a deed that makes the transfer.
The granting clause.
That's the heart of any deed, the granting clause. 10 is D. A legal promise can also be called
Covenant.
a covenant. 5 is E. A document used to transfer title to a parcel of real property.
That's the deed.
That's the deed. 7 is F, correct. The mean sea level at New York Harbor, also local 0 elevation point.
Datum.
The datum, yes. 6 is G, datum. A deed stating that the grantor has not encumbered the property.
CAG.
The bargain and sale CAG type deed. 3 is H, correct. A declaration to a notary or other official to prevent forgeries.
Acknowledgement.
Your signature has been acknowledged. 1 is I. A marker placed by the U.S. Geological Survey stating elevation. What do we call the marker?
Benchmark. But it's also called something else. It's the first.
Well, I'm sorry?
It's a benchmark, but it's also called something else. The first point, I believe, right?
Well, the marker that's placed by the U.S. Geological Survey stating elevation is called the benchmark. That's what we call the marker. So 4 is J.
Okay.
Now, what do you call a measurement of elevation? That's the datum. That marker could state what the local datum is. As of this point, what is the elevation?
Yeah,
But what do you
that's
call
what
that? The actual metal marker that they put there in the ground or on a rock or in a brick or what have you? It's called a benchmark. Now, key terms 2. The spot at which the meets and bounds description begins and ends.
point of beginning.
It's called the point of beginning. 6 is A. A fixed natural man-made object identifying boundaries in meets and bounds descriptions.
Monuments.
Monuments. 5 is B. That's the when you get a survey done, you could pay the surveyor to put one of those monuments. It could be a piece of wood, a piece of metal rebar in the ground, or a ribbon on a tree if a tree is sitting at the corner point, so they don't got to cut down a tree and hammer in a marker into the into the tree. It basically shows you what the corners of your property are, where the corners are. Most properties have 4 corners, but many can have You could have 5, you could have 3 corners if it's called a flag lot, or it could be many different. You could have a weird shaped lot that has many corners and arches and curves on it, which get more complicated, but and more expensive to put all of those monuments in. But yeah, the monument is what we call that steel stake or piece of wood that you put in the ground there, or the ribbon that you pin to a tree. Those are the monuments. 5 is B. One who transfers title by signing a deed.
Grantor.
They grant the ownership. 1 is C. Description sufficient to identify a parcel that's acceptable by a court of law.
Legal description.
It's a legal description. 3 is D. To have and to hold clause that explains the ownership being transferred. If they just say that explains the ownership being transferred. What's the clause in the deed that begins with the words to have and to hold? How about that? The have and to hold clause is the
Warranty.
habendum clause. 2 is E.
Yeah.
Deed providing the grantee with the most protection of all deeds.
That one is a warranty.
That's the warranty deed. 9 is F. System for land description used in Western states. What's a legal description of land in Western states? Not in New Jersey or the 13 original states.
Rectangular survey system.
Rectangular survey also goes by government survey. 8 is G. A deed releasing any interest grantor may have without claiming season.
Quitclaim deed.
A quitclaim deed. 7 is H. And a description using boundaries and direction.
Meets and bound.
Meets and bounds. It stands for meters and meets, like meters, distance, and direction, the boundaries. 4 is I. And that concludes chapter 9.